Good afternoon. We're going to get started. Hi, everyone. I'm Linda Hammis. I'm the publisher of Foreign Affairs Magazine, and I'm thrilled to welcome you today to the Cryptocurrency Policy Forum. All right. Who was that? Thank you. Focus today will largely be on Bitcoin, though much discussion about regulation will apply to other digital currencies. Bitcoin has been proclaimed as the most powerful innovation in finance in 500 years. It's been called the Internet of Currencies. It has been said to be a revolution that can change millions of lives, including in the developing world. Detractors denounce Bitcoin for its volatility, saying it should be thought of at best as a commodity and at worst as a bubble or even a Ponzi scheme. It has been blamed for facilitating illegal markets, cybercrime, even kidnapping. Yet others have debunked Bitcoin as a financial service, but praised its application as an internet protocol to solve other global problems. No matter what, our speakers, and many of you experts in the audience too, are bound to engage in a highly relevant topic of debate today. In fact, one of our speakers today was called away to present to President Obama's team in preparation for his speech at Stanford. Woo! I think we need some more of those woos. Feel free. Yeah, thank you. Yeah. So our goal here at Foreign Affairs, as always, is not to espouse one view or another, but to increase knowledge and discussion about regulation of the blockchain technology and to shed light on the public policy debate around Bitcoin. Some order of business. Please, I don't want to have to say it again. Silence your phones, but feel free to keep the Twitter conversation going at #FALive. FA Live. This event is on the record. There will be Q&A sessions at the end of each of the three panels. If you're called on by the moderator, please stand, wait for the microphone, state your name and your affiliation, and stick to one question and make it concise for the rest of us. Thank you. Without further ado, let's begin and get started on the first panel, The Future of Payment, which will focus on the mainstreaming of block technologies, including the question of regulation. Our moderator, he will be recognizable to many of you, Jerry Brito, the Executive Director of Coin Center. And our other esteemed panelists include Karen Gifford, Chief Compliance Officer at Ripple Labs, Patrick Murck, Executive Director of the Bitcoin Foundation, and Shere Wallwork, Senior Counselor for Strategic Policy at the U.S. Department of the Treasury. Jerry, take it away.
Thank you so much. Thank you all for coming. Just to start off by telling you a little bit about Coin Center. Coin Center is a nonprofit research and advocacy center. It's based in Washington, D.C. And our mission is to make sure that policymakers, the media, understand the technology, that we have the right policy research from academics and experts that's available to inform the conversation, and to advocate for the freedom to innovate on top of these technologies. So that's what we do, and so I'm very happy to have this fantastic set of speakers with us. And I thought maybe we'd begin by just going down the line and having each of them say a little bit about themselves and how they see the mainstreaming of this technology. So Anne, why don't we start with you?
Okay. I'm very pleased to be here. I work in an office at Treasury called the Office of Terrorist Financing and Financial Crimes, which is a policy shop under a wider umbrella of the Office of Terrorism and Financial Intelligence. Later in the second panel, I believe, the money laundering panel, you will have the opportunity to hear from the director of another component of that office, Jen Shasky Calvery, who is the director of FinCEN. Other components of that office are OFAC, the Office of Financial Asset Controls, which is the sanctions implementer for the U.S. government, and an Intel shop, the Office of Intelligence Analysis. And I should add here that I speak for myself personally and not for officially for the Department of the Treasury.
When does anybody ever speak officially for a federal?
Well, And the mission of our policy shop, TFFC, is to identify systemic risks in both the domestic and international financial system and develop strategies to mitigate those risks. We work extensively internationally, including through the Financial Action Task Force, which is the international anti-money laundering, counter-terrorist financing, and counter-proliferation financing standard-setting body for the global financial system.
Great. Patrick?
Hi, thanks for having me. Patrick Murck, I'm Executive Director of the Bitcoin Foundation. Bitcoin Foundation is a nonprofit. Our mission is to fund research and development into Bitcoin Core and to support the Bitcoin Core Development Project. So our chief scientist, Gavin Andreessen, who chafes at this but is sort of like the Linus Torvalds of Bitcoin, was able to join us, so thanks Gavin for showing up. If you really have real questions about Bitcoin, you should probably ask him, not this guy. But he was smart enough to sit down there. As part of our mission, we fund the research and development into Bitcoin Core, and we provide new avenues for people to contribute to the Bitcoin Core software development project. So from our perspective, there's this emerging new digital economy that's forming. And to really inform that and make it open and participatory, making sure that things like Bitcoin Core are well supported is probably the best way to achieve that goal, to make sure that new digital economy that's coming down the pipe is open, is participatory, it's free for everybody to be involved in. Whether that ends up being backed by Bitcoin or whatever coin down the road, this project will at least, at a bare minimum, keep things honest. And one of the interesting things about Bitcoin, when you think about all the different systems that are at play, and you have things like Ripple, which is a neat little consensus system that's able to kind of serve as connective tissue between silos of data, financial data here and there. With Bitcoin, you have the creation of the first real digital hard asset, which, if you think about it, is kind of a weird, almost oxymoron, right? Like, wait, a digital hard asset? That doesn't make sense. But that's what Bitcoin really is on the blockchain. Some people use it as currency. Some people speculate on it. Some people use the blockchain to do completely different things. And from our point of view, there are three key components to Bitcoin and the blockchain that make the whole thing work. And that is a trusted ledger that requires zero trust from the participants in order to make transactions happen, a native token that you can use to represent either recursively itself or something else that you're using, and the freedom to kind of transact across that network. And if you have those three things, then you have a transaction system that actually works, a root level system that works. It doesn't have everything you need to maybe comply with, the travel rule or this rule or that rule or everything. But those things can, somebody's in trouble, by the way, I think, right? Yeah.
Thank you.
Yeah, you're welcome. But you can always layer those things on top. You can build, it's a building block, and you can build those things on top of the system. And you're seeing those waves of innovation happening and radiate out from Bitcoin. Keeping it simple, make sure that if I want to use Bitcoin and the blockchain for financial services, say, then I can do it. And I can layer in just in time, just what you need, identity information or things like that, and do really innovative, cool things to prevent people from using the blockchain for bad, illicit purposes. But if I want to use it for, say, voting, having identity baked in at the protocol level may preclude that avenue of innovation entirely. So making sure that there's lots of extensibility and optionality by keeping the protocol simple is something that we're very interested in, making sure software developers have the freedom to contribute to that project. So that's what we do, in a nutshell. That was the short version. Sorry.
All right.
Go ahead.
Karen.
Hi, I'm Karen Gifford. I'm from Ripple Labs. So interestingly, the private sector representative on this panel works at a company that doesn't actually use Bitcoin. We do use the Ripple protocol, which is an open source protocol similar in that sense to Bitcoin, which is also open source, but differs somewhat, and we'll probably talk a little bit over the course of this panel about some of the distinguishing features of the Ripple protocol. Essentially, it permits funds settlement from any currency to any other currency in close to real time, in 2 to 5 seconds, and close to free for about a millionth of a dollar. So we view our protocol, or the Ripple protocol, as something that can serve as a standard for fund settlement, and as such, provide interoperability between various payment networks. If you have a standard that applies to something very, very simple, like ownership, that sits sort of at the bottom of all of the various infrastructure pieces that need to be in place for a payment system to exist, that very simple standard can permit interoperability of systems that appropriately have other standards. So a wholesale payment system, for example, would have different rule sets and different risk mitigation measures than a retail payment system. A payment system that operates in one part of the world might legitimately have a very different rule set than a payment system that operates in another. But one thing that everyone can agree on is ownership, right? So we're hopeful that that the work that we do with Ripple will enable really a flowering of transactions and interoperability between systems that permit, much more economic activity, much more global, many more global transactions, and kind of the same kind of vitality that we see in information with the internet happening in the world of financial transactions. So the way that we at Ripple Labs are approaching this is through enterprise and a focus on banks and other financial services providers. When we look at how the internet started, really universities were the ones who in the beginning were the big users and promoters of the internet. So there needs to be sort of institutional players, we believe, to get something like this started, to start fairly significant change. And that's where we're focusing our attention and our efforts. Notwithstanding that, we think that these new technologies will not be limited to enterprise, but that's where it will start. And similarly to the way universities were the first places where people were using the internet, we think ultimately years from now there will be just like a vibrant ecosystem of many, many different kinds of companies, entrepreneurial, large scale, and things that we're not even really imagining now, that are engaging in many different kinds of economic activity using these new technologies.
So on that note, the purpose of this panel is to talk about integrating cryptocurrencies into the mainstream, right, to the mainstream financial services. And so we've talked a lot about how this is like the internet, how we can't imagine what's going to happen because it's an open network, anybody can build on top of it. But let's talk concretely, right? What value do cryptocurrencies, does Bitcoin, does Ripple have for mainstream financial services today? Where do you see that? So let's start with Patrick.
Yeah, so the value in the blockchain today is, in some degrees it is a little bit speculative and we are a little bit out there, right? So, and it's interesting because you can draw a distinction between, say, the Ripple consensus network and what Bitcoin does, and trying to keep it simple here, but there are two different systems at work. With Bitcoin you have what's called proof of work, which means that there's these miners out there, and there are people who are doing a lot of work and expending energy to make sure that transactions can occur and that they can do so in a trustless manner. So that if I want to send you some money or something of value somewhere, whatever is appended to that token, I can send it to you, and I have a certainty that it will get there, and you have a certainty that it has been, that it's yours, and that no one can double spend it, no one can take it, no one can counterfeit that transaction. And at no point in that system do I have to trust anybody. I don't have to trust a canonical ledger somewhere or anything else. It just kind of happens. And so
Is trust a problem today?
Is trust in settlement a problem today?
Yeah.
Yeah, I think it sometimes is, but it's mediated, right? It's mediated by different institutions, whether it's banks, if it's clearing houses, settlement companies. There are a lot of financial fiduciary trust kind of centers that right now mediate that trust out of and take the risk out of the system for people who are transacting on it, right? And allow you to kind of measure your own risk. What this does is it removes those people from the system, essentially, and allows you to create that transaction without having to go through that third party. And that was the big innovation that happened with Bitcoin. And so what value does it have for a mainstream consumer? We're seeing, international remittances, Bitcoin used as a currency or as money or as an asset to move things from here to there. There's a lot of what's called the Bitcoin 2.0, where you're trying to attach some sort of equity or a deed or some piece of information that's valuable into the Bitcoin itself or into the blockchain and transacting it across the network. And so that's where you're seeing people starting to add value now, and where the investment is being driven is how can we take this open transaction network and build on top of it in different ways, and what's going to be the killer app thing that catches on. I don't know what that killer app is going to be yet. I don't think anybody knows, to be honest. I think there's just a wide variety of investment in different directions.
Okay, so speaking of killer apps, Karen, when I hear people talk about Ripple, I'll often hear them say it's trying to replace correspondent banking. Is that essentially what Ripple is trying to do? Is that with the mainstream value?
That is one very obvious use case for the Ripple protocol, definitely. What I can say about that is Ripple enables point-to-point settlement, and it does enable point-to-point settlement across currencies. So that is one thing that's that is a little bit different between the Ripple protocol and a payment system that would use Bitcoin. So if you were trying to do cross-currency transactions using Bitcoin, for example, if you're going like dollars to euros, you'd have to go dollars to Bitcoin, Bitcoin to euros. With the Ripple protocol, you can do directly dollars to euros, or between any other currency. So it's in our view, a little more fluid for transacting in the cross-border situation. And what Ripple does do, because it's point-to-point, because it permits direct settlement, it enables any bank potentially to transact with any other bank across borders. So at this point right now, we have one bank in Europe that's integrated the Ripple protocol, Fidor Bank in Germany, and there are 2 US banks who have now begun integration work with the Ripple protocol. And what the advantage is for those US banks is that up until now, a smaller bank really didn't have direct access to the global financial system. If it wanted to send money across borders, it had to go through one of maybe 6 global banks that have the physical presence in many different countries to send money around the world. So accessing that network is very, very expensive. It can cost $1 million just to set up a correspondent account to have access to the global financial system with one of these correspondent banks. So for the smaller banks that are integrating the Ripple protocol, they can now offer their clients effectively correspondent banking services. They can send payments to Europe directly and do it and directly compete with the largest banks in the world and do it faster and more cheaply than those banks are able to do it. So it's not speculative. It's really happening right now today that this technology is enabling faster and cheaper payments.
So, Anne, from a policy perspective, what's the value that cryptocurrencies bring to the mainstream?
Well, assuming that they can comply with the international standards established by the FATF and with the national legal frameworks in various jurisdictions, including the United States and our Bank Secrecy Act, and Jen will talk to that, we very much favor financial innovation that supports transfers that are more efficient, less expensive, and that can bring more people into the regulated financial sector. I mean, there's a tremendous value in that, both in terms of economic policy and in terms of anti-money laundering, counter-terrorist financing policy.
So I'll ask all of you, so what you've all identified disrupts certain incumbents. How are the incumbents reacting?
I could start to speak to that. So we really don't view the Ripple technology as disruptive. We actually view the Ripple technology as extremely constructive. And And the reason why we do is I think there's wide acknowledgement by all players in the financial services industry that payments are too slow, they're too opaque, and they are too expensive. And that is certainly not a Ripple Labs perspective alone. I mean, the Federal Reserve has been doing this series of payments improvements, a call for faster payments papers. They just came out with their most recent one last month, and the message that they are consistently giving is that payments need to be faster, they need to be cheaper, there needs to be more access to cross-border payments for the average person. So all of these things are
Implicitly what they're saying there is that the incumbent systems have not delivered on that.
well, no, I would say the incumbent systems, the current correspondent banking network as it exists today does work. A lot of the technology that was built in the 1970s, and I think there's recognition among those incumbents that something needs to change. So we haven't, our experience within Ripple Labs is not that the larger banks are uninterested in this technology, quite the contrary.
So Patrick, what do you see incumbents?
So I think that for most of the people who are incumbents in the space, whether they're in any way acting as like custodians or registering kind of deed of title, or if they're sitting anywhere in chain of title on any sort of asset class, you have to look at the blockchain and think to yourself, is this something that somebody else in Silicon Valley is going to go build a company out of a dorm room and eat my lunch? Or, secondly, is this something that could improve my margins internally? If I start using Bitcoin internally as a way to record assets, record deed of title, to do those things and make those transactions happen cross-border, globally, instantly, but in a zero trust environment, then what does that open up for me as far as like new opportunities, new potential? And I think that's what most people are seeing, is that you talk to these large incumbents, the banks, people who are supposedly being disrupted, and I think that they're taking a longer view on things, and a more strategic view, and saying, well, maybe this could disrupt us, but if we just bring it inside the house here, then we'll just disrupt ourselves. And that's, disrupting yourself is a lot better than being disrupted by somebody else, right? So let's do that. And I think that's what you're really seeing happen right now. And I think it's interesting when you talk about like the consensus model that Ripple is built on, and Bitcoin, and how they kind of can work together, and how they vary in certain ways. And when you see the evolution of financial data, you start with like bank-to-bank transfers, right? Very siloed data, and it's one-off transactions bank to bank. And then you have something like Swift, which creates kind of like ways to move data through this portal to other siloed bits of data. And then you have something like Ripple with this consensus ledger, where you're essentially creating a web of trust, right? You still have to trust that all the people on the nodes have the dollars and the euros and the yen, so that when you make that instant transfer, I can get it at the end, but you've created a connective tissue around it. And then further down the chain, you have the blockchain, which is you've completely broken out trust entirely, and now you've taken the data out of the silos and published it out into the cloud completely. And I think that's the spectrum you're on. So for some people, they may find that it's a little more comfortable to sit a little further down and do the consensus model and like work through this, or they may find that this zero trust environment is expensive, and it's not like it's not for us, because we just want super fast settlement, and that's fine. And they'll find the right technology to meet their needs, I think. But it's definitely something that you hear consistently from the people who are supposedly being disrupted. You see the New York Stock Exchange investing in Coinbase, right? Like, so they're obviously taking a long view on it.
Yeah. So, we've been talking about instantaneous cross-border payments, which is something that I'm sure perks up the ears of regulators and folks at the Treasury.
And policy folks.
And policy folks. So let's talk about, if we're going to have a regulatory regime at this, it's going to have to be international in scope, perhaps. But let's talk first about, Anne, what are the international concerns that this raises for you?
Well, I think first and foremost is the money laundering, terrorist financing, sanctions evasion risk that comes when you have a global system that is anonymous, in the sense that while the transfers themselves may be transparent on the blockchain if they're not tied to a real world identity, which they are not necessarily tied to, then you have a potential for complete anonymity. And so both identifying people who are accessing it, using it, and then eventually cashing out and interacting with the current regulated fiat system in jurisdictions around the world becomes an issue. We don't want to see a system develop as an alternative to a very carefully and thoughtfully risk-based regulated global financial system under international money laundering and terrorist financing standards that allows regulatory arbitrage and that creates weak links around the world for entry into the regulated system. So on the one hand, we very much are supportive of financial innovation, to have more efficient transfers, to bring more people in, but we really want to see compliance with a very established global set of standards that the FATF has established. And first and foremost is customer identification and verification, and monitoring and record keeping, and reporting of suspicious transactions under the criteria that have been agreed to by the international financial system.
So, when you have closed proprietary systems that are run by companies, you can see how you could apply such a regulatory framework, how to enforce that. It becomes a little bit more difficult when you have an open network sometimes. So how do you deal with that?
Well, that's true, and I think one of the issues that jurisdictions around the world are confronting are the regulatory challenges. But these international standards in the first place do not apply to individual users. They apply to the FATF standards require countries to implement anti-money laundering, terrorist financing controls on financial institutions, and also designated certain other entities that are not formal financial institutions, that are designated non-financial businesses and professions. But financial institutions are defined by activities. It's all activity-based, and it's all conducting financial activities on behalf of third persons. So it's not like there's any requirement to impose regulation on the Bitcoin protocol or a Ripple protocol, but when financial institutions are conducting defined activities, whether it's money transmission, accepting deposits, running a payment system, these are some of the categories of financial activities that define a financial institution under the global standards, then money laundering, terrorist financing controls do apply, and that's not nearly as difficult. If you're setting yourself up in business in a jurisdiction to use these protocols, then you are a node that is engaging with the fiat system, and there are established criteria and requirements set internationally that then the particular jurisdictions around the world implement through their own national legal frameworks. So that responds to the money laundering, terrorist financing, and sanctions implementation. There are other issues that I'm not really particularly qualified to speak to, but the Bank of International Settlements, for instance, is another standard-setting body, and it is concerned with, payment systems integrity, cybersecurity, network security, safety and soundness, all of these issues that in this country are dealt with more on a state-by-state basis. But I think that probably there will be some push if this industry is to, obtain trust and to obtain, greater traction and legitimacy for these kinds of issues, given that if it's going to function like a payment system, even if there isn't a centralized entity, how are they going to meet those requirements? And I would think that, again, just as with the anti-money laundering, counter-terrorist financing controls, you apply those kinds of requirements not in the ether, but to the specific businesses that are engaged in accepting funds, whether it's or value that substitutes for funds, as we say in terms of our regulatory structure here, whether it's fiat currency or virtual currency. Is there enough, money in the bank or in whatever the trusted, repository is to handle, the consumer's needs, and what happens if there's a failure, and how do you protect? We've already seen around the world kind of the cyber hacking, what system requirements do you impose to protect against that. So I think that, yes, it developed as a very individual-based type of thing, and individual users will be outside kind of the systemic requirements that are for businesses, although certainly if they do bad activities as individuals, either terrorist financing or money laundering, whatever, that's also controlled by criminal law, you're going to need to have the kinds of protections in place in some fashion for it to take off.
Yeah.
So let me, go ahead.
No, what's interesting is, when I hear that, it just reminds me of, whenever you inject trust back into the system,
Yes.
inherently regulation will follow, right? And so the best systems, and I tell entrepreneurs this, I'm sure you do too, Jerry, I think we're of a like mind on this. When you're building systems out there using the blockchain, these open technologies, figure out ways to build them responsibly, right? And figure out ways to build them with as little trust as possible required for the end user, right? You have less concern as a regulator about safety and soundness if you can prove irrefutably as a consumer that all my funds are held safely, or they're not held in trust by somebody else, right? If I have complete access, or I know that you don't have, as the exchange, exclusive access to my Bitcoin, then I'm not as worried about the safety and soundness of those assets.
So I'm going to get a little wonky here.
Please, that's your job.
So, I mean, the reason that we have some of these capital requirements is because there's an information asymmetry problem, because you can't tell whether the money is there or not.
Yes.
When you have a provable system, well, now you can tell. So are you saying then that we don't need these regulations anymore, or just that it's easier to comply with these regulations?
I think so. So before I went down this crazy path of digital currency and Bitcoin and all that, I was a telecom attorney. And so when you look at the history of telecom, you have systems that were very, very regulated, and there's just one or two. There was AT&T basically, right? And it was heavily, heavily regulated. It was a common carrier. They had to do a bunch of different things, different types of regulations for different types of concerns. Heavily, heavily regulated. As that broke apart and as those services unbundled, the regulatory environment had to shift and accommodate that sort of unbundling. And the regulatory requirements now are very different today for the telecom industry than they were 20, 30 years ago. Now we talk about net neutrality, right? Back then we talked about common carrier regulation. So things have changed then to accommodate these more open networks. And I think in finance and banking, you're going to see that same evolution. You're seeing it occur where you have regulations that are built for these kind of common carrier, too big to fail institutions, and you're going to see it have to evolve a little bit so that it kind of everybody is meeting the needs of each other. People who are building services using the blockchain can build responsible services that serve the goals that you're trying to attain, which is stopping illicit funding and things of that nature. And at the same time, the regulations are going to have to adapt a little bit to understand and accommodate this unbundling effect of all these services. Instead of just being in one bank, now being available to me on my phone here, and I can record my deed of title there, and I can send my, I can pay for my car, and it's an embedded payment when I, open the door to my car and I turn it on, and there's all this crazy stuff that people are building. So the regulations will adjust and the people will adjust.
Karen?
I'd just like to pick up a little bit on what you were saying, Patrick, about whether or not these technologies enable compliance in a setting where there's trust, which is obviously where my company's focus is, right? Mm-hmm. So on the banks and financial institutions that do have these regulatory requirements, it's interesting to see that sometimes these open protocols actually make compliance more straightforward and easier. Mm-hmm. So like with the Ripple protocol, there's point-to-point settlement, which eliminates the whole series of hops between various financial institutions that currently happens today when a payment is made across borders. Those series of hops are completely opaque, and the sending institution doesn't even necessarily, usually doesn't know what other institutions that payment will pass through before it reaches the recipient. So to be able to settle things point to point creates much more transparency, which has implications, of course, for the kinds of anti-money laundering issues that Anne and her work at the FATF is focused on. It also has good implications, very positive implications for things like the new fee pre-disclosure rules under Dodd-Frank. I honestly don't know how any bank can comply with those rules if they're not using Ripple. I mean, I'm not saying that to
Nothing sells like fear. Just
right. If you don't know in advance where the payment is going and what fees are going to be added to it before the recipient gets it, it's extremely hard to comply with pre-disclosure. And my understanding is that what banks are doing in order to comply is just raising their fees so that there's a cushion, so that they don't get caught under disclosing the fee, which is really the opposite result of what everyone was hoping for with that regulation. So the banks that we're seeing that are integrating the Ripple protocol are really excited about the fact that because the settlement is point to point, they can pre-confirm what the fees will be and disclose it to their customers in advance. And it's the actual amount. It's not a guess.
So, we've been talking about having a cohesive international framework, but Anne, you mentioned state by state a minute ago. In the U.S., we have 50 different.
48.
Well, always a stickler for the details. We've got 48 plus 2 out there states that have not completely different. I take that back, but different enough regimes for licensing where you have to navigate each of those, and that generates friction in what is essentially a global market, at least a national market. So, how do we deal with that? Is that something that's going to stop this cryptocurrency from entering the mainstream? I'll start with you.
I don't think so. I think you're already seeing an effort by the states through the umbrella organization of the Conference of State Bank Regulators, which is the umbrella organization that in the states also regulates money transmitters, looking at, they formed a task force, and then on December 16th they issued a policy statement and an outline of the types of issues that all of the state should consider in regulating virtual currency exchangers, money transmitters, administrators, depositories, hosted wallets. They listed the types of entities that they thought should be regulated under the state concerns, which historically have focused on consumer protection, safety and soundness, payments, and network security. And they articulated as one of their first kind of principles a need to support innovation and to develop a consistent framework across the states. They pointed to the desirability of establishing consistent licensing standards and using possibly existing databases. The National Mortgage Licensing System database is one that they're looking at. I think the Director of FinCEN can talk about efforts to coordinate state supervision and enforcement, but I think, when the money transmitter laws were developed in the states that regulate and license, there wasn't an internet, and there was this kind of balkanized development. Now there's very much an awareness of internet-based payments, national payments and global payments, and a need to facilitate financial innovation by having consistent regulatory regimes across the states and articulate. I think this is a good beginning. I think you also see New York, the Department of Financial Services, fleshing out this type of what this would look like in practice with the so-called bit license proposal that's still in draft and is receiving comments. The Conference of State Bank Supervisors Task Force consisted of 10 of the most interested states, and New York was part of that, California, Texas, some of the other leading ones. And I think that they're soliciting comments I think next step is likely to be a model law if you had traction for that. And I think, interestingly enough, the virtual currency industry is creating, I think, a whole new kind of ecosystem for and pushing the need for that and for innovation and also a consistent regulatory approach that we didn't see before. Before, with the traditional money transmitters, for instance, you had a couple of really big ones. They had handled it, over time. Now you have a bunch of startups coming up and saying, this is really onerous, and not only that, but we're looking at this whole thing as an experiment, and we're, operating and kind of the back and forth between new entrepreneurs and a heavily regulated financial sector, and that, on the one hand, friction but also positive engagement. So I think that it's a very fertile area, and I think that, certainly both at a national level and state by state, governments and the private sector want to support innovation. They want to be centers of entrepreneurship, but we also need to have the protections that for both consumers and for our payment system.
So I definitely agree. It's a good beginning. But Patrick, Karen, do you think that the CSBS policy statement and framework and a bit license is going to get us to a consistent 48 state, not 50?
And we will all sing Hakuna Matata, and we hope for consistency, right? You hope that you can send one application through the NLMS, and you then apply to every state, and then you get a license, and it's everything is great. That's not usually how it plays out in practice, right? There's always going to be little differences here and there, and it's going to be a little bit hard. But again, it takes me back to the telecom days and the PUCs, the Public Utility Commissions, and things like that. If I want to string copper wire, right, and I want to do it in Idaho, then I'm going to have to go to the Idaho Public Utility Commission and deal with the FCC, and it's the same multi-layered approach. And if I want to string it across 2 states, then I got 2 states to deal with and all that. But if I'm Skype, I don't have to go to the Idaho PUC to figure out whether or not I can deliver peer-to-peer VoIP services, right? And that played out a certain way, and there was a reason for it. You did have to go to the FCC, and they did fight, and it was Pulver, and they fought. And you wonder, with some of these services, what are you exactly trying to regulate here? Again, you're trying to regulate from a state level trust, consumer trust. Can I put my money in this institution, which in the past, like copper wire, was inherently local to that state, local to that community? And can I trust that I'm going to get it back, right? And that's primarily 98% of what the states are concerned with, except for New York, which also wants to do money laundering too. Some people laughed. So again, you wonder, is that maybe the right framework here? And I want to let Karen answer that too a little bit, and maybe Jerry, because you have experience with.
Well, but I'm the moderator here, and I just want to ask.
I want to jump in.
Let me just ask Karen one thing, and then I'll come back to you, Ann. I just want to ask Karen. Well, how long do we have to know whether it's working or not, and what's the alternative?
Well, so just my own background is that I worked at the New York Fed for many years, and that is, so my biases come from that time. And so coming from that background and also seeing what I'm seeing in the work I'm doing now, I have to say my perspective is that payments are the backbone of the financial system, and that we have a national economy, and the idea that we are going to create a fragmented payment system by state just makes me sad. Like I think we're, like America should be one economy is how I feel about this. So if the state regulators can pull together and create national standards, that's great. And I've been really encouraged by the kind of engagement that I saw in the bit license effort and also with the CSBS. But I just really, really strongly feel that these new technologies, whether it's Ripple Labs or a Bitcoin technology, whoever is doing this is the future. And this is an important development for our economy and our place in the world. And I just really think that this is something that should be, the standards should be articulated nationally.
Ann?
And that actually segues back into what I wanted to add, and that is that from an anti-money laundering, counter-terrorist financing perspective, every single one of those states essentially says that if you comply with the FinCEN, the Federal Bank Secrecy Act, that's our anti-money laundering, counter-terrorist financing law, regulations, then as far as we're concerned as a state, you comply with our needs. So that is, in fact, in that context,
Right.
A de facto national standard. I think that the fact of the matter is we on the one hand, did get rid of regional and state banking requirements, that was one level, but we still have a system where banks are regulated in part by the federal banking authorities and in part by the states. So the idea that you're going to have a payment system that is different from a kind of state-based protective system, I think I do agree that we need to have consistent standards. I think that the states recognize that, and I do think that there are coordinating mechanisms that weren't there before, and that there's more of a private-public partnership on that.
That's true.
All right, I think we have a few minutes for questions. So if anybody's got a question, raise your hand up high, and I think I see one right here. Yes, sir.
With respect to the operation of the infrastructure in the blockchain and the relative opaqueness of what is going on amongst the miners and the guilds, while waiting for or looking for or hoping for major institutions to start taking advantage of this technology, do you think there'll be a push or a pull for some kind of transparency, registration, identification of who is doing how much of the mining at any particular time? Or
So when you say opaqueness, I think you mean it in a different way than maybe I think of it, right? Because all the mining activity is public, right? I mean, when a miner mines a block and they add it to the chain, they broadcast it out, so they know how many fees, what the fees they are taking, what the block reward was for them, essentially their total compensation for adding that block to the blockchain. You can see all the transactions in the block. You even have probably a little bit of location information about them and things like that. But you might not know exactly who that individual is or that corporate structure or whatever. And the question, I guess, you then go back and you ask yourself, as you say, why does it matter? Does it matter to me that my transaction to Jerry went through somebody in China, or if it went through somebody in California or Ontario? Does that matter to me, right? Does it matter to me as a consumer? Or does it matter to me as two businesses interacting? I know that it's cleared and settled, and I don't have to trust the miner to make sure that it cleared and settled. So the question is, why is identity relevant, and what aspect of identity is relevant in that context, right? And usually when you're talking about the settlement person, the Visa, whoever's processing it, that identity and that corporate structure and the type of transparency you're talking about is relevant because I don't trust you, right? Or I shouldn't trust you with my money because it's not going to get delivered to Jerry. There's misdelivery and all these other counterfeiting, whatever. But if I don't have to trust you and my transaction gets through, then I think that transparency is enough. And you also, of course, know the size of that mining guild, the size of that mining pool, and all those different things. So,
Other questions? Okay, right here.
Hi, I'm Brian Kelly. I'm curious, I represent kind of the Wall Street voice here as an investor in Bitcoin. And I'm curious, as you're looking into the policies and how you're developing Bitcoin or Ripple, it seems to me that there's really no intrinsic value to the currency at the core of all of this. So when you're developing, do you think about the investors in it? And really operate now, Bitcoin operates on a greater fool theory. which is fine until you run out of fools. But what happens then? Are you guys planning for that at all?
So Jerry, you want to? No, I'm joking. No.
So I'll answer just a little bit. This idea that Bitcoin has no intrinsic value is always a funny one to me.
Yeah.
Bitcoin is a network that allows you to send value instantaneously globally. That's valuable. That's the intrinsic value of Bitcoin. Like, what's the intrinsic value of email?
Well, but there's
Okay, we're gonna have. This is the panel's gonna answer the questions. Okay.
So and that's right. That's exactly right. So there's value in the network. There's value in the blockchain. Having this river of information running through the internet is incredibly valuable. And the Bitcoin itself, the coin, even though there's no real coins in Bitcoin, but sorry, I didn't mean to go there, but the coins, right? That's your ability to sign instructions and add data into that river of information that runs through the internet. That's valuable. There's some real value there. And there's proof of work. There's actual mining and electricity and hard costs that go into securing that network. And that creates real value in that token, right? That token means something. It means I can access this network, I can sign an instruction, and that instruction can operate on the blockchain. That means something to people. And it will become, hopefully, and the speculators believe that access and that instruction setting will become more valuable over time. Ripple is a little bit different.
Yeah, and I'd agree with many of the things that you're saying.
Yeah.
I do have a somewhat different perspective, and again, I think this comes a little bit from my Fed background and just like thinking about money a lot. But what was that? Huh?
No, it was
You've got mail.
a phone.
Phone?
Yeah.
Oh, was it a You've Got Mail? Oh, that's cute. So
We are at a tech conference,
Right.
right? I mean, I didn't know it was like 10 years ago.
We were talking about closed proprietary
well,
networks
tech and
versus.
money,
Yeah,
you could be
right.
talking 10 years ago. But so just to circle back to what we were talking about is the intrinsic value of these virtual assets, right? So you can think of like, so what is the value of the money that we think of as fiat currency, right? Like you could say it has no intrinsic value either, right? But we are very comfortable with the idea that it does have value. And so where does that value come from? There's at least two places, and I'm like happy for people to offer more, but one is as a store of value, and one is as a means of transacting. And just the way, like, this is just my personal way of thinking about this, but like if you think about Bitcoin being created, it was like the first virtual asset. It was the first asset that could exist electronically. And it's really, a great store of value and does that well. And if you analogize it kind of to gold a little bit, like gold is a great store of value. Gold, the value of gold goes up in times of uncertainty. Bitcoin was created in times of uncertainty. It was created like close to the time of the financial crisis. And it's gold is volatile, Bitcoin's volatile. But it doesn't mean that it's valueless. It just means that it's serving a certain function, and it's kind of optimized for that. It's not. It's a little clunky to transact with. Gold's a little clunky to transact with, but people do it all the time. With the virtual asset that's part of the Ripple protocol, we call it XRP. So XRP just serves a couple of functions that make the protocol work well. One is that it is the source of the fee for transacting. So a small amount of XRP is destroyed every time you transact. The purpose of that is to discourage spamming attacks. That it's designed to feel free to the person who's transacting legitimately, but if you're trying to do a denial of service attack, it will become rapidly too expensive to do. It also serves as a bridge currency between other currencies, so it enhances the interoperability of the protocol. So when I look at XRP, I think of it as more analogous to something like the dollar, which is kind of optimized for transacting. If you think about how people use the dollar, like if you get a bunch of gold, you put it in a vault. If you get a bunch of dollars, you don't hold on to them. You pretty much quickly, start transacting in them. You don't really. Most people don't put a lot of dollars in a vault. They start investing them or they trade them for other things. And the value of the dollar is really related to, you know, how useful it is for transacting. So that's just like my personal way I think about these two assets.
So I want to move on to getting one more question, but I will point out that we didn't answer the gentleman's question, which is, do the developers think about the investors as we're developing? So that's a question maybe Gavin can answer later when we mingle.
Generally, no. I don't think that's yeah.
One more question? Oh, back there.
My name is Bill Leginski. This is, I guess, directed towards Anne, I'd say. It seems like a lot of what Anne and Karen, the points you brought up, are kind of the value proposition of Bitcoin and Ripple in terms of, I guess, reducing regulatory friction, which is something I hadn't thought of before, but I thought it was a great point you made about the pre-transaction knowledge, and then you were talking about MSBs and kind of standardizing them. And what struck me is that my question is, number one, who government-wise, I guess, would be best positioned to kind of evangelize this, and how would you go about it? You know, so it becomes part of the discussion in the political arena. I'd say in terms of helping people see. I mean, this could be the killer app of this technology, couldn't it? You know, in terms of the government backing this kind of technology could be reducing the friction of regulatory, you know, compliance.
So, I mean, I agree that regulatory acceptance is basically key to the success of this technology, for sure. And that's one reason why I spend a very large amount of my time talking to different regulatory agencies. So yes, I couldn't agree more. I guess, yeah. Yeah.
So you're talking about getting regulatory acceptance
right.
of technology, but doesn't the technology facilitate the regulator's job? What you're both saying right now?
Well, I mean, I think
saying.
yeah. I think we should let Anne speak to that to some extent, but I did just want to have like one last point to your point. I mean, I think, you know, a technology is a technology, and there's usually, you know, like, and regulators have legitimate concerns that they are trying to address, right? So there may be some regulatory concerns that can be addressed technologically, but chances are there's still going to be a need for rule sets. I will say there are, like, I see a number of benefits for the technology, for the Ripple technology that I'm most familiar with. So like the Dodd-Frank example is one. Another is I think what we've been talking about a bit is the fact that it's point-to-point across borders. So like a lot of the concern that people in the anti-money laundering world have around cross-border transactions has to do with the fact that those transactions are inherently opaque because they go through a number of hops, and like in those hops, that's where a lot of funny stuff happens. Like, you know, when you've seen like really, really significant violations of sanctions rules, it's because people in the series of hops between banks, people have been stripping information out of payments of the payments messaging and obscuring the origin of payments. So,
but that's contrary both to a specific international standard that requires beneficiary and wire transfer information that goes through financial institutions, so that standard addresses precisely that issue of having the information at hop to hop to hop to hop so that you do have the transaction trail. And it's also contrary to our own.
I'm not saying the people who did that were breaking the law.
It's not like there isn't an existing framework to address that opacity. If there's implementation of what should be in every country's domestic framework and certainly is in ours, then you don't have that opacity. But with respect to whether the government should drive the adoption of a particular technology, certainly that's not the case at this point. I think probably there's general awareness that the Federal Reserve Board is looking at various models and methods for making the payment systems more efficient, and digital transfer mechanisms, I think, is their terminology, which could refer simply to electronic versions of fiat currency, or it could refer to decentralized virtual currency. That remains to be seen, but I think there's a lot of interest in that. From a perspective of, is it helpful to have a trail that's electronic? Yes. Does the Treasury Department and the Internal Revenue Service favor electronic filing and say for income tax and refunds, or for the delivery of social benefit networks? Yes. So, to that extent.
You were telling me earlier that the U.S. engages bilaterally on cryptocurrencies.
Certainly, and also regionally.
And what does that mean? What do you exactly tell your counterparty bilaterally?
Well, I don't want to step on Jen's lines, but we really think that that we have developed in this country a risk-based approach that makes a lot of sense, which is that we focus, and this is strictly about money laundering and terrorist financing controls, but we look at money transmission. That's the regulatory framework, but we look at the nodes that intersect with the regulated financial sector. So we're looking at administrators of convertible, centralized convertible virtual currency, and exchangers and hosted wallet services, businesses that are at that intersection of fiat currency and virtual currency, and place the national regulatory framework for money laundering, terrorist financing, the MSB framework there on that, and that's where we're focused. I noticed that when Karen talks about the Ripple protocol, she's talking about bank access, and banks are highly regulated. They have these requirements. There's a very developed supervision and enforcement system. But it's not just banks that are the gateways for the Ripple protocol, and so those non-bank entities, including entities outside the U.S., would be of concern to us. We want to see all jurisdictions implementing appropriate
it's interesting.
regulations.
I am.
And this will be the last word, because we have to wrap up. I'm being told.
Timed it perfectly.
Awesome.
Thank you, Jerry. Yeah, focusing on the critical control points, I think, is good, no matter what those critical control points are on the network, of course. I think every crisis is an opportunity, right? So we have this, again, it's happened in other spaces before. You have these technological disruptions happening, and usually when that happens, things are democratized, things are unbundled, and things get a little bit weird. So you have these things like the travel rule, which are designed for the SWIFT network, right? For me, when you look at the blockchain and you look at these peer-to-peer technologies and these different approaches, it's an opportunity. For example, take identity. This is a great opportunity for all of us to rethink what identity means in a digital world, especially for financial transactions. And we should really, really be focused on that. Not to replicate what existed in SWIFT encoding, but to create a new framework that allows you to meet your goals in a better way. So the idea of just in time, just what you need financial information, that's a great idea. Let's use that. Let's figure out what the bad transactions are first before we collect everything you've ever known about yourself and transmit it over the network, right? That's a great way of thinking about how we can bridge the gap here, in my opinion.
All right, optimistic.
Try to.
Thank you all so much for listening to us, and thanks to the panelists.
All right. Okay, don't go anywhere. Don't go anywhere. We are starting right on our next panel. You're going to have a chance to have coffee after this and chat and debate. But first, I want to get to know you a little bit. I have a question. How many of you, honor system, are current owners of Bitcoin? Wow. I think that's 50%. Maybe 40%. Okay, how many of you were owners of Bitcoin at this time last year? Huh, interesting. Smart people sold their Bitcoin. How many of you have purchased goods or services with Bitcoin? What did you purchase? A hat. Where? Overstock. Plane ticket. Okay. Computers? Nightlight. Rafting trip in New Zealand. I think that's impressive. Yes? I'm sorry? Right. All right. Okay, and how many minors do we have in the house? Wow. I'm impressed. Okay. All right. Well, as we're getting our next panel mic'd up and ready, we're just going to put another chair on here. I will, for the purposes of time, I will start the introductions. One of the fiercest debates around cryptocurrencies is their facilitation of crime, especially money laundering. And we're going to hear from our experts here today on what kind of regulation could balance the constructive, as we heard, potential of the protocols that this last panel talked about with the protection of consumers and investors also. Thank you for that question. And enforcement against crime. Come on up. All right. Hello. Please welcome our presider, Richard Zabel, the Deputy U.S. Attorney for the Southern District of New York. Mr. Zabel will be leading a discussion with John Beccia, raise your hands, General Counsel and Chief Compliance Officer, Circle Internet Financial, Jennifer Shasky Calvery, Director, Financial Crimes Enforcement Network, U.S. Department of Treasury, Brian Stockert, Managing Director and Chief Strategy Officer of Coin Comply, and Carol Von Cleef, Partner, Co-Chair, Global Payments, Menat, Phelps, and Phillips. And again, after this discussion at 5:30, we will break for a short coffee break here in this room before our last session of the day. Thank you.
Should we start?
Yes, please.
Great. Hello, everybody. Thanks for coming, and thanks for having me. So I'm not doing any introductions to our great panelists because you have that in your programs, and there was a brief introduction already. So we'll set the stage so we can get right into things. Virtual currencies like Bitcoin and other such currencies that you've been hearing about today are obviously a potentially revolutionary development in the world of commerce. And they offer a lot of advantages, some of which we'll hear about more today and which I think you've heard about before, over government-backed currencies we're more used to, providing greater efficiency and lower transaction fees and other cost benefits and greater privacy for those who want it, a currency system that's not tethered to the government and its centralization. But at least from my perspective, which is colored definitely by being in law enforcement, so that's my bias, and I recognize it, and I'm working through it, and you'll help me work through it today. It's sort of a therapy session so I can believe in the world. But virtual currencies benefits, and especially for us in law enforcement, and I think Jen will talk about this too, the anonymity and scale they provide have made them a magnet and a vehicle for some very serious crimes, such as money laundering, narcotics, serious cyber crimes, child pornography, and more. In 2007, the Justice Department, just to give a little history, brought its first major case against an illegal digital currency service that was involved in money laundering and enabled users to conduct anonymous transactions that were often illegal. That was the eGold case. So our panel is going to focus on the relatively short past, at least in my view, somewhat turbulent present and unclear future of virtual currencies. And the panelists and I will look mainly at the virtual currency business, I think in the context of regulation to prevent things like money laundering and other illegality, and I'm sure we'll stray into other areas and hear about many of the benefits that some of the people here spend every day thinking about and counseling people on, like Carol, and how the government and private sector view these issues and what they mean for the public. So let me take a few moments just to set the stage with a federal prosecutor's vantage point, which, as I said, is a conflicted one at best. So in the Southern District of New York, which is the district that I'm the Deputy U.S. Attorney in and comprises Manhattan, the Bronx, and other areas north of the city, but we do cases that are really global in nature. We've never been one to slavishly adhere to the boundaries of our jurisdiction, and we're proud of that, because it allows us to deal with things like, worldwide cybercrime. But in the Southern District of New York, digital currency, mostly in the form of Bitcoin, has actually played a central role in over half of the major cyber-related cases we've brought in the past few years. In many ways, the criminal activities in these cases are the same crimes that we've seen with traditional currencies, like money laundering and fraud and Ponzi schemes and hacking. But the use of digital currencies in these cases has been a bigger challenge for us, mainly because of the heightened anonymity. It's not pure anonymity, but the heightened anonymity, which makes it very difficult to track people who are doing the crimes. What I said before about scale, the global scale, is a really severe challenge if you're in law enforcement, because it means some guy in a basement in Latvia can be doing things that are affecting us here and setting up global crime networks that may use digital currencies as their currencies for purposes of evading law enforcement, and can get many more people involved in it. So as you may be aware, just to give a sample of some of the cases, just last week a jury convicted Ross Ulbricht, a case of ours, of all 7 counts in connection with his founding and operating the Silk Road website. Silk Road was basically an online bazaar for drugs and all sorts of other illegal services. And Silk Road lived on the, as some call it, the dark web, and offered this marketplace of illegal goods and services. Payment was accepted only in Bitcoin, so obviously that was in the interest of those who were conducting these criminal enterprises to rely on a digital currency, which concealed the identities and locations of the users who were transmitting and receiving the funds through the site. After Ulbricht was arrested, very shortly thereafter, Silk Road 2.0 was created, and it operated in the same way. Welcome to the world of law enforcement. And its operator and creator, Blake Benthal, was also arrested, and his sites were seized. In 2013, we brought charges against the operators of Liberty Reserve, a company that operated as one of the world's most widely used digital currency services, and really we viewed it as the premier bank for cyber criminals. The company had more than 1 million users worldwide who laundered more than $6 billion in suspected proceeds of crimes that included credit card fraud, narcotics trafficking, and child pornography. Those are obviously not new crimes, but the scale with which they were committed was really quite astonishing. And as we allege, just so it's clear, Liberty Reserve created its own digital currency called LR, and that facilitated the crimes being committed with greater speed and even greater anonymity, because to get into their system, you had to use currency exchangers to even buy Liberty Reserve digital currency, and Liberty Reserve did not want to know and did not know who was entering and exiting their system, because they did it through currency exchangers in places like Malaysia and Vietnam and Russia and some other places like that. And that allowed great speed, great anonymity, and great volume to the criminal activity. We also recently convicted Bitcoin exchangers, some of whom were engaged in facilitating criminal conduct and had formed Bitcoin exchanges. And just a few months ago, in November 2014, we brought the first federal criminal securities fraud charges against the operator of a Bitcoin-related Ponzi scheme. That operator, Trendon Shavers, basically guaranteed to cover any losses in the event of market volatility to Bitcoin, but he was just essentially taking everybody's money in one of the oldest criminal schemes, even though it was digital currency. It was basically a tried and true Ponzi scheme. So there were people that were getting into it who thought they were going to make a quick buck because they'd be completely protected and only would profit. So now you can see why I'm psychologically hobbled regarding digital currencies, and Jen may be a little bit too, but maybe not. She's probably maybe more open-minded than I am. But that was really just, I went through that not to flay digital currencies in any way. It was really just meant to set the stage a little bit for some of the problems we encounter in law enforcement. And I want the discussion to be a balanced one. There are obviously tremendous benefits and tremendous potential in future to digital currencies, and even if not to particular digital currencies, to the technology that has been created around them, I think. So without any further ado, I'd like to start talking to the panelists about this. And John, can you balance out my incredibly negative, dark view of digital currencies and talk about why we don't need to fear money laundering and all these crimes happening? And I'd like everyone just to jump in whenever they can. I'll move us along as best we can, and at the end, we'll save some time for questions. If someone will give me a 15-minute warning, that would be good, because in keeping with my lack of technology, I don't have any timekeeping device near me.
Yeah, well, definitely not going to put you on my marketing team, but
that's why I'm in government.
Exactly. But no, those are important, issues and risks, and there's been a lot of talk about the risks and things that have been happening out there in these early days. We're still in very early days of this industry, and there's a lot that needs to happen in terms of regulation. A lot needs to happen in terms of the industry developing best practices to address those issues. It's not only money laundering, it's security issues. You might have heard of Mt. Gox and other exchanges who have been hacked, and so issues around protecting people's assets and security and those types of things. And so, I think being an early industry, a lot of these things get magnified too. And you look at the traditional financial services institutions. I come from a banking background. You have bad actors, and you have people trying to game those systems as well. They're going to try to find the next best thing and the holes to jump through. I think the first panel did a pretty good job as far as talking about the benefits of digital currency, and there are a lot. Definitely the payment system as it exists today, there needs to be changes. Certainly if you do a credit card transaction, that's 2% fees associated with that, 2%, over 2%. If you're doing cross-border transactions, you can pay up to 9% just to spend your own money. And so what companies like we're trying to do is offer another development to the payment industry. I think payments have changed quite a bit over the last 10 years, and they're going to continue to adopt. The technology itself, the blockchain technology and Bitcoin, I think it's really compelling, and it's something that, whether it's going to be Bitcoin in 10 years, I'm not sure. I don't have my crystal ball, but I think, the fact that payments are going to develop and evolve is clear, and I think, and so I think there's definitely a lot of benefits. But again, I was really encouraged to see the poll of all these people who use Bitcoin in this audience, but there was a great Coin Center study that just came out. Most Americans don't even know what Bitcoin is, and so how do we address that as an industry? I think it's really dealing with those risks head on, and I think it's I think from day one, when I came into this, I was calling for regulation, because I think you need to address those risks. You need to have consumer confidence. And people need to feel that this is another legitimate payment type of vehicle, and so you need to have that in place. And I think the technology just needs to evolve. It needs to catch up, and we need to come up with easier ways for people to understand. People don't need to understand mining, and they don't want to know all these things that are happening behind the scenes. I mean, for mainstream consumers, frankly, if I wasn't in this, I don't know if I would own Bitcoin right now. When I first started this back in 2013, I told my family I was joining a Bitcoin company, and they said, "What do you do?" They looked at me like I had 10 heads. So again, we're in real early days. It's like the early days of the internet. I remember trying to go online and buy something and saying, "Am I really want to do this? This is early in mid-90s. Is this safe? Is my money going to be safe?" And I think that's where we are. And I think 5-10 years down the road, I think this is going to be a really compelling thing for individuals.
Well, I'm actually one of the largest holders of Bitcoins derivatively, because we seized $16 million of Bitcoins from Mr. Ulbricht. So I have another interest in another. I might be manipulating the market. So tell me, maybe Carol, Brian can jump in and say, Are we able to protect people, though, in the meantime? John makes a good point that this is in early stages of the technology, but there are people getting hurt. You talk about Mount Gox, and I think there was an incident just recently in Hong Kong where there was a big fraud based on Bitcoin, and then people were agitating in Hong Kong to ban the currency from the city, partly because of fear people were getting hurt in the meantime. Can you guys address, how do we balance protecting people and preventing crime, allowing this new technology and new currency to grow, but and I'll turn over to Jen too, not letting people get ripped off and not letting rampant money laundering and rampant criminal activity, the proceeds of which are sometimes being laundered, be exploited in the meantime?
Well, I guess I'd like to take a slightly different perspective and say that we are sort of in early days, but we've really been experimenting with digital currencies going back to at least 1995. And so the case that you referenced in 2007, which I will respectfully disagree with the characterization of involving an illicit, illegal digital currency system. The e-gold system, and now full disclosure, I've been working with the principals of that company since the completion of the criminal proceedings. But it's very important that people recognize that the judge in that case took judicial notice of the fact that the system itself was not illegal, and even went so far to say, after the principals had signed plea agreements pleading to criminal charges, that she did not believe that they had illegal intent. And so where I come at this whole area is helping people avoid the mistakes that were made with respect to the launch of that system and addressing the issues that the system faced. Because rule number one that we without doubt, and I know Jen has made some very good comments to this effect, the first adopters of new payment systems, without doubt, are the criminals. And for someone who brings out, whether it's a system system itself, or brings in a piece of infrastructure, say in the Bitcoin world, that they have to realize who's going to come to the table, and they have to be in a position to protect themselves. And when they don't have those protections in place at the appropriate time, then things can spiral out of control very, very quickly. So we're doing a lot of work. I'm working with the Chamber of Digital Commerce, which is a new trade association representing the digital currency and asset community. And one of the key elements that we're doing right now is education. We're trying to get out to the young entrepreneurs as fast as we possibly can to get them educated with respect to the kinds of risks that they're up against and the types of steps that they need to take to protect themselves.
I'll go back to the key piece, which I think is it's starting to become a generational thing, right? We're talking about entrepreneurs that are 18, 19, up to 25, right? Looking at technology, growing up in technology, minimum use of the traditional financial system right now, very minimal use, meaning they got an account through their parents, and that's pretty much the last time they're going to go into a bank. They get paid in ACH. They utilize and transfer money through mobile devices. They share rides. They, share apartments. The sharing mechanism, I think, is a key component that we're looking at. When we're talking about the control aspect, I think very early on, very Wild West, absolutely, 100%. I think the guidance that came out from FinCEN back in 2013, which I kind of call a little bit of a landmark piece, right, is really what set the table, right? Because very early on, people created their own homemade email policy, and people were actually publishing these things, which is kind of hilarious because banks try and keep these things as close to the vest as possible. Yet these people were throwing them out there like they were, like, hey, look at me. The next aspect was sort of understanding what they needed to do, and it was sort of, okay, now I'm an MSB, now I've got to create a BSA program, but then they felt, a lot of these companies, that it was just a policy document. It wasn't actually an active living program that needs to be catered and monitored, operationalized on its life cycle. So we're sort of getting into that phase. I think from the regulatory aspect, where you're sort of starting to turn to is there's a significant demand in the market to actually engage, but there's a lack of faith, right, in trustful companies, right, that companies like John's or other companies that people can say, I believe I can put my money there. it's safe, and I can eventually get my money out or use that money, right? What you have in Hong Kong and you have in Japan and you have in these other jurisdictions is, I mean, just crazy risk of people putting money in there on the whim. And there's even a case where someone, I think about a year and a half ago, who took a significant amount of Bitcoin, sent it to someone online, and they said they were going to get gold bars in response. Like, you're just an idiot. I mean, there's just no way to look at that.
Was that person a Nigerian prince?
That was the only thing missing from it, to be honest with you. But I mean, you could just look at that situation, and you just know that there's no positive coming out of that. So I think it's getting closer to this aspect with a little bit more clarity at the state aspect, at least in the United States. I think we all go back to that because that's the same amount of friction. But I think you're getting more to the point where if there's more companies in the marketplace that people feel comfortable with, there'll be more use.
So Jen, I wanted to give you some time to hear some other points rather than follow my dark vision.
Cynical.
Yeah. So you've heard some of these points, all which seem very important and significant. I mean, and please take it in any direction you want. But are you, the last point, especially about that regulation is now somewhat in place and growing with Bitcoin, and maybe I guess a maturation process may be going on. That's a very difficult process. I mean, there are established financial institutions that are not able to keep up their regulation with the scope of their activities. To then expect young, very young people who set up a company that's not even brick and mortar, to kind of to respect the need for regulation and follow an evolving technology and adopt the regulation, which takes a lot of thought and maturity that sometimes escapes people who are far older and far more experienced. Do you think that path is being traveled now, and from your perspective as a regulator, and please, go off in a different direction if you want, but do you think that's the direction it's heading in right now?
Yeah, sure. Let me set maybe the context a
Yeah.
little bit and then jump in that direction. So I had lunch around the corner today at the Asia Society, so I think I'm channeling Asian philosophical tenets here, but I'm not
get
sure.
hungry.
Yeah, right. I'm not sure if you started out the conversation, is Bitcoin bad? Is it good? Are cryptocurrencies good or bad? I'm not sure that they're either. They just kind of are at this point, and they're here, and we need to deal with them. FinCEN is a bureau in the U.S. Department of Treasury that reports to the Undersecretary for Terrorism and Financial Intelligence. We have two roles that are relevant for today's discussion. First, we're the federal regulator for anti-money laundering, countering the financing of terrorism for the U.S. government. And that means we both draw up the regulations, those federal regulations, and we enforce those regulations. The other hat we wear is that we're the financial intelligence unit for the United States, and that's a term of art. Most countries at this point have an FIU. It means that we collect, we maintain, analyze, and disseminate different types of financial intelligence that's provided to us by banks and other financial institutions and by other reporting entities. So we kind of wear both of these hats as we think about this. When it comes to the regulatory framework, and do I think new companies can keep up with the regulatory framework? I do. In fact, first of all, I think it's their obligation. So the regulatory framework pre-existed the advent of Bitcoin. It was in 2013 that we clarified that Bitcoin exchangers are a type of money transmitter, but the rules about money transmission and that they would have been subject to pre-existed that. We just clarified for the market that they apply to Bitcoin exchangers. And so when individuals create a new company in an existing regulatory framework, they have an obligation to make their product, their services, compliant with that pre-existing regulatory framework. The regulatory framework can and should change over time and innovate with the market and adapt to a changing market and the needs of the market. But until it adapts, the existing regulations apply and folks need to comply with those. Certainly our largest, most complex financial institutions and big banks have very sophisticated businesses, first of all, operating globally and with a variety of products and services. and an extreme variety of clientele. And so their AML programs are by necessity very complicated. But we also have small mom and pop businesses, many of whom are probably on the street corners here. A bodega that also does check cashing is a type of money services business subject to our regulation. Sometimes the owners don't even speak English as a first language, so all the challenges associated with complying with regulations in that type of atmosphere, and they're able to do it by and large. We certainly have across the industry instances where folks are not able to meet their regulatory or won't meet their regulatory obligations, and that's what enforcement is for. But I'm optimistic that this market or this type of service, like any other, can meet the regulatory burdens.
So how,
Can I just make
yeah,
one point?
yeah,
I mean,
please.
I think I just want to echo a point that Brian made, and I think what FinCEN did with the guidance was just really pivotal for the industry. I think the perception early on was that Bitcoin is a libertarian movement, and Bitcoin was, there's just too much risk associated with it. And so I think, for legitimate companies, it really helps provide that consumer confidence. And I think, it helps take things out of the kind of the dark shadows, and companies like ours, who are registered as an MSB, who are licensed in the States, have to go through and have those things that you talked about as far as, a KYC program and transaction monitoring and regulatory reporting, which are very important to the system. And I think, it's helped as the industry has developed, and you look at now, you have over, about $400 million of venture capital funds coming into this space. You have a lot of interest, a lot of new dynamics, and it's a global phenomenon with several startups coming into this space. And so I think, the willingness of the regulators to collaborate, not just FinCEN, but all the regulators. I think every agency has a working group on this. The CSBS, New York State, it's interesting dynamic, especially coming from the banking background. Usually it takes a crisis for regulators to act. Here we had really, and it's, we're in early days, and so we can help actually build this framework and not have to deal with some of the legacy issues you might have on the traditional financial services side.
And just to add on to that, we, beyond having now not only the regulatory framework and guidance and clarity in place, we have just begun our examinations. So IRS.
By that you mean you're going on site and inspecting
Exactly.
the way other agencies have done?
Exactly. So IRS performs the examinations on our behalf at the federal level. We went through and did training for them late last year, and they have now begun their examinations. So I think that gets us to the next step of starting to kind of give the businesses out there a sense of what the expectations are and what's going to work and what's not going to work. It's going to further develop the industry.
And if I could add to John's point about the guidance coming out in March of 2013 being a pivotal point, I think it was really a 1-2 punch, the guidance coming out in March, but then the seizure of some Mt. Gox assets in May of 2013 was, I think, that was the second punch that really made people say, wait a second, okay, they really mean business with this. And I think that it'll be interesting to see the reaction from the industry when the enforcement actions do start to come out in this area.
And is there any tension that you're finding in terms of that as the regulations start to kick in and you have know your customer rules and things like that? Can you regulate it sufficiently and keep the core of what some of the goals of having Bitcoin are, and that people be attracted to it still, or do they move on to another digital currency then?
Yeah, absolutely. I think one of the misconceptions or things that are talked about a lot about Bitcoin is it's anonymous, right? And that's actually one of the benefits. The transaction itself is anonymous. So when you're making a transaction, whether it's person to person, person to merchant, you're not giving over your personal information. You're not giving your credit card number. So that's very compelling for a consumer from an identity theft protection perspective. But the transaction for a company like Circle, we know our customer. That's not anonymous. So we do full KYC. And I would say that we do more than traditional banks. And so we don't have to deal with these legacy systems. The model in bigger financial institutions has been, hire 1,000 compliance people to review case alerts and things like that. But we're actually able, because we're a technology company too, is to build something from the ground up. So we when we do KYC, we look at IP addresses, we look at geolocation, we do document validation, we have our customers do selfies and do visual recognition. I mean, it's great. I mean, it's we're taking it that next step, and I think some of the things that we're developing can actually be brought into traditional financial institutions and will be helpful. And I don't think that takes away from the use case at all. I think people who want to use this, legitimate people, now this might eliminate the bad actors for sure, but the legitimate users of Bitcoin and digital currency, I think we're willing to deal with this just like any other financial product or service.
I think from a payment aspect, and to John's point, when we're looking at it, the one advantage a lot of these companies have is the fact that they have very little legacy infrastructure, right? So they can build very fluid systems very fast. You can get an online system up that's of legitimate quality. I'm not going to say it's compliant. I'm saying it's legitimate quality within 3 to 6 months, right? That someone will be using. But on the other hand, when you look at the fact that your traditional financial systems have systems that are built in the 70s, they're bootstrapping on top of bootstrapping. These companies are coming in with engineers right off the bat. There's, sometimes it's a small group of engineers or an army of engineers. They're looking at the most effective, fast way that you can make money move, right? Which is going to be a lot faster than the traditional banking system. And I think that's one of the greatest advantages. Now, is that going to push the traditional financial institutions to, try and keep up? I absolutely think so. I think they're going to be in a hard position to do that. On the other aspect, the more I think we keep hearing about these privacy data leaks and cybersecurity aspects, I sort of wonder whether that's really going to be the magnet to more sort of digital currency based methods, because of the fact is, if I go to Target and I buy a piece of furniture or something, if I buy it in cash, they don't take my information. They just take my cash. They're good, right? But if I use my credit card, I've got to turn over all my money because I got to go to the credit card company. The credit card company's got to take all that data. This way they can actually go back and pay. And as someone said earlier, find me so I can pay. With sort of a digital currency, you may be in a situation where you're going to find yourself that maybe there's going to come a time where people do not want to be able to turn over that much information for sort of day-to-day purchases. And that may end up being a sort of use case for it, that you're going to hold X amount day to day when you go to Starbucks, you go to Target, you go to whatever's around here, Office Max or something. There's nothing in this neighborhood. There's certainly not bodegas here.
Not a lot of Bitcoin usage right around here.
But I think in the day-to-day purchase element, that may be a huge, huge draw, to be honest with you. I don't think just at this point, but I think longer term, that's going to be a key piece.
So all that sounds very promising. How does that intersect with with foreign exchangers and currency exchangers? I think you've thought about that. I'm sure you're dealing with our foreign regulator partners. Is it a system that's evolving smoothly and sort of in a coordinated fashion abroad, or is it you lose control when things go outside the United States? We'll talk about states and the patchwork that exists within the United States, but how does it function globally, since that's part of the idea, is efficiency and getting all around the world?
Sure. Maybe just a quick reaction to a couple things that Brian and John said. First, on the technology end of things that I think are real opportunities and do apply globally, and then I'll get specific into the global piece of it. The idea that these are new companies with that are very technology savvy by definition, and are creating new systems, including new compliance systems, does provide an opportunity. So when I put my financial intelligence unit hat on, and we're trying to trace funds of criminals and other illicit actors, the kind of reporting that we're getting from some of the Bitcoin exchangers is quite good. They use that technology mind to provide some really good reporting and do some work that is incredibly helpful to law enforcement and to us at FinCEN in terms of being able to trace money. So being able to adapt new systems under new technology, today's technology, and with folks that have a sense of how technology can be a benefit in this area is proving to be very helpful. So I think there are benefits there that we're starting to realize. In terms of dealing globally, the regulatory framework, I know FATF is working on the international standard. That is often the first part of this is, what is the standard that we all hope to live up to globally, and then nations enact their individual laws to meet that standard. So FATF is already talking about and has been about virtual currency and how nation states should be thinking about it. Here in the US, we have our approach. Many other countries have approaches as well, but they're not all where we need them to be in terms of having a regulatory framework, which does provide that opportunity for criminals to play regulatory arbitrage and go to the kind of lowest common denominator jurisdictions to act. That's nothing new. We see that, and I know you've seen that in your many global cases that you bring in SDNY. That's criminals specialize in that type of regulatory arbitrage and innovation. So that remains true. From a financial intelligence unit perspective, all the FIUs around the globe, we are sharing information. We're sharing information related to the misuse of virtual currencies and our approaches on how we're tracing funds that go through this type of a system. And so I think folks are catching on pretty quickly.
And when you folks are counseling people or dealing with people in the private sector or getting into this business, are you finding that people find the regulatory framework too daunting to enter the business, or they decide that it's just too piecemeal with the different states, or too onerous with the federal guidance?
Well, I think it's important to keep in mind we've got two sets of rules that we're dealing with. The state licensing structure is separate and apart from complying with the Bank Secrecy Act and the type of compliance programs that you need to put into place. The comment that I hear probably most frequently, and again from the less experienced entrepreneurs in particular, is that, well, what are the rules? And much to Brian's comment, is that you're dealing with tech-savvy, by definition, tech-savvy individuals in these companies, and a lot of them are engineers and they're rule-based. And they want to know what the rules are and how can I boil this down into a rule. And I know we've got Juan here in the audience who is very much of that school as well. And they're looking for something more concrete to latch on to. So for example, in the area of KYC, know your customer, we hear about that all the time. Interestingly enough, to the extent that these entities are money service businesses, there's in fact not really a specified know your customer or even a customer identification rule that is applicable. We borrow upon concepts from the banking world, but if you're looking to hold someone to a specific standard, it's more of a best practices standard that's at play. And that's difficult to have that kind of conversation. John's mentioned some very sophisticated types of tools that his companies put into place. But people say, well, where in the rules is it, and why is it I need to do this? So I think there's a need for greater guidance along those lines. We want to be careful in what we ask for, but this is probably one of the biggest frustrations.
So we're constantly, whether it's the kind of new entrepreneurs in the cryptocurrency realm, or even long-term regulated industry, depository institutions, casinos, et cetera, are always asked, give it to us black and white, exactly, give me a checklist of the 10 things I need to do, and we'll make sure we do those things. The rub there is the way the regulatory regime is set out is it's on a risk-based approach. It's not prescriptive, the exact opposite of a risk-based approach. Prescriptive, you'd get your checklist of your 10 things and you would go about doing them and you'd be done. The reason that we're risk-based is criminals are going to immediately adapt to the 10 checklist items, probably even before we finish printing them on the paper what they are. They will have already heard about it and adapted and have a new criminal approach. And so what we're asking industry to do is, this is your customer, you're dealing with them, you have a sense of what looks normal and what doesn't look normal. And so take a risk-based approach, focus on what the high-risk areas of your products and services are, high-risk jurisdictions, high-risk customers, and based on that, we need you to implement your AML controls and program.
And I guess that's, no one in American commerce has ever missed a risk area. But that's part of the problem. I wonder about is how people can, or what, especially when you're in a competitive business and you're trying to start up a business and establish it. It's hard enough for people to appreciate and take a moment and say, what's my risk area? What's my new risk area? I got to address that. I've got to and think of a way to address it. Are you finding that people are able to do that? And these are young entrepreneurs, which is great, but that's a harder thing even when you don't have a lot of experience in the world to understand what is a risk-based approach. It took a lot of people in the hedge fund industry a long time to learn what some of the and not all of them have learned it, but what were risk areas in that when that was relatively new. So do you find that's a challenge, or Brian?
I think it's a little bit of a challenge. I think one of the greater challenges is the businesses pivot very fast.
Mm-hmm.
Like one day I'm going to be an exchange, the next day I'm going to bootstrap a BTM that's located in this country, and it's going to go in that country. I'm going to connect up with this exchange that's in this foreign jurisdiction, and you start at point A and you end up at point B, and then 3 months later you're at C, and then you're at D, and then you went back to B again, right? Like it's very hard to just kind of draw the line in the sand with the companies very, very early on. We find at least the ones who are sort of coming right out of the incubator phase, they have a model in place, they have an idea, and then they sort of start hitting certain little checkpoints and roadblocks where they're like, that's going to get me another $2 million worth of funding that I can't get right now. So what can I do before that, right? And then the issue with the traditional banking system in the U.S. is trying to gain access, right? Because whether people want to believe this or not, if you're in the regulated financial services world of digital currency, you need, if you want to operate, you really need a U.S. bank account because you want to have ACH or wire transfers. And that's been a major, major issue in the U.S. because of the fact that the financial institutions, these companies are being lumped as MSBs, and then we're going to go into the high-risk category, then we're going to go into the de-risking element, we're going to get into that whole potpourri of loveliness that just has been a long-standing issue for a while, right? So they just got lumped into this entire bucket. And that's sort of been where the next level of real friction is. It's at the state level about the regulations, and two, it's at this level of the traditional financial system. Now, the banks are very interested, right? And the more tech-savvy banks, right, are going to be a lot more interested than others. But that's really where some of the next pieces are, because if they don't get bank accounts in the U.S., where do we think they're going to go?
Mm-hmm. So so what I hear you saying partly is some of these businesses, they start out as one business, soon they're pivoting fast, and they're 5 different businesses which have different risk areas, and they're not necessarily keeping up with that, which is an old problem.
Right, and Jen, your organization has done this. You've seen these requests for, does my business model mean I'm a money transmitter, right? You've gone through 10 or 12 of these already. That's been a very common theme is, how do I build a business model that doesn't make me qualify as a money transmitter, right? And then you keep telling them no.
Yeah.
So.
It's easier just
You
to
noticed that
qualify.
too. Yeah. There's a lot of, I think, denial out there.
Right. That's it's like funds that you say, how do I do it so I don't have to register with the SEC or
I
something?
mean, look, I get on the one hand the desire for that, but that's part of, if you want to be a part of the U.S. financial system, if you want to be a part of the global financial system, that's no small thing. You're not just setting up a small sporting goods store on the corner that doesn't have global implications. You're doing something much different. And when you start talking about point-to-point transactions and pseudonymity, global point-to-point transactions and pseudonymity behind those, and instantaneous movement of value over borders, that has real risks associated with it too. So it's all about, on the one hand, trying to have smart regulation that deals with some pretty significant risks, crime and terrorism risks, while also enabling innovation to happen so that we can get all the benefits of that innovation. But what keeps me up at night when I am thinking about digital currencies and what I need to be concerned about there, not the regulation, we can kind of deal with that, but the risks, the real threats out there. What do we need to be concerned about? These days, whether it's in the digital currency space or otherwise, we're thinking a lot about ISIL, or also known as Islamic State or ISIS, and how they're moving their money, and how potential U.S.-based individuals are becoming foreign fighters. Are they moving their money? Can we identify them by the movement of their money? And what does it mean if they start moving that money through Bitcoin, as you started to see some public articles suggesting that it has occurred. So,
Well, it
there's
makes
real
sense,
risks out
'cause
here.
terrorists have adopted a number of fully encrypted communication systems for
Exactly.
that very reason, so they can't be identified. You, Carol, you wanted to respond to
I
something?
do, because I think way too much time gets spent and wasted on trying to figure out whether an entity is a money service business. And I tell a lot of my clients, I said, I really don't care whether you're an MSB. You still have obligations under the federal criminal statutes not to be involved in any way in money laundering or terrorist financing activities. And as a result, you really need to put into place a compliance program that is very similar to what you would do under the FinCEN rules. And a lot of this comes from the experience from the Eagle case, because if you go back and you look at the Eagle case, at the end of the day, the company was cooperating in a number of very significant investigations worldwide, but their lawyers put everything on the line on the issue of whether the entity was a money service business or not, and they lost that in the courts. And because they weren't paying attention to having to look at more sort of globally the money laundering related issues, it's just a different set of filter that a company needs to look at. And if you can get past that, I think we get to the place from a public policy standpoint that I know certainly FinCEN's interested in. And then it means less cases for your office, but
We can live with that. John, do you want to?
Yeah, no, I just want to address the issue of like the regulatory framework and whether it's a challenge for on the business side. And I really don't think it is for legitimate businesses and people who want to operate in this space. And I think, for young tech entrepreneurs, they can just bring in people with gray hair like myself, or hire someone like Brian and his firm to do compliance and build programs and all that. I think there's two main areas though that are challenging, and one is lack of clarity, lack of certainty, if there are issues, especially at the state level where we are now. So for example, a company like Circle, we've applied in all states for a state license, and in a large number of them, they just pushed back and said, we don't know what to do with this right now. We're just holding your application, so just stand pat. So obviously that's not
You were
good.
waitlisted.
Yeah, we're waitlisted. It's not helpful from a business perspective. Number two, we talked about it, it's the technology. It's evolving so fast. So really, it has to be a risk-based, it has to be a principles-based type of regulatory framework that can evolve. We all want to, obviously catch the bad actors. We all want to protect consumers and do, those are all legitimate and important goals. But making sure that we can also encourage the innovation. That's kind of the push and the pull here. And so making sure that we can, to have that is important, when thinking about a regulatory framework. And then, so for example, the New York BIT license, and again, this has been a very collaborative process, and I think you see in this last proposal a lot of positive changes. But there's one provision there, for example, all new products and services need to be pre-approved by the superintendent. For a business or an industry like ours, that's a very difficult provision. The technology is evolving very quickly. To wait 6 months for a new product or feature to be approved by the DFS, it would be very challenging. So it's those type of things that we're trying to work through and trying to address, both at the regulatory, from the regulatory framework and also from the industry perspective. And I think the onus is a lot on the industry too, to develop best practices, not only to wait for the regulators, but also to develop best practices. So, we've gone out and done things like, we've secured private insurance for protection of our consumer funds if there are a theft of assets.
I was going to ask, is that widespread insurance of accounts and funds in the Bitcoin business?
So I think, we've opened up that market, and I think, things like that to, provide these additional protections over and above what the regulators require.
So I was visiting my colleague Ben Lusky just this morning, since I was in town, and asking him about the BIT license. We were talking, amongst other things, about how can we coordinate our activities and share training and so forth, so that we are consistent between the federal approach and the state approach. And I was asking him, I told him I'd be here this afternoon, and I inevitably get a question, what do I think about the bit license?
Right.
And I said, Ben, is there any particular theme that you would want me to answer? I don't know if I'll say exactly what he says, but I'll say, I want to at least hear. And he said that I should just say that it was brilliant.
Yeah.
We support
And you
it.
did it for him?
Yeah, no. I told him that I'd be supportive about the fact that they're showing leadership in this area.
Yeah. You can tell them people raised eyebrows at that one. So I want to get to some questions in a minute. We have about 50 minutes left. But I want to ask a question. We've been talking a lot about the challenges from without, and by that I mean regulatory and outside challenges to how Bitcoin operates and how it functions. So Bitcoin, unlike government-backed securities, depends on this technology, and there's been some concern that I've read about from within the currency, in the sense that if someone gains control of the currency, I guess this 51% problem that you guys are probably familiar with, and if you're not, then we'll just move on. But with Ghash and others, that it could immediately cause all sorts of invalid transactions and non-payment and cause a control within the currency. That seems quite different, although there are other concerns, but quite different from government-backed currencies. Do you have any concerns about that? Even if we achieve perfectly nice, good regulation, and Jen's great agency and others are able to move as fast as the technology requires to enable this, that the currency being dependent on technology may ultimately, eat away itself?
Yeah. I mean, to me, it's an issue and a risk in theory, but not in practical terms. I think, these miners have gone from, little mining rigs in people's basement to, really billion-dollar industry as far as, these large rooms and warehouses, and a lot of venture capital money gone into this space. And there's an economic incentive to make sure it's a legitimate practice and make sure that these transactions are being processed. And I think, if someone were to take over the network, immediately you would just basically take down all of the work and all of the incentive. And I don't think there would be a benefet to do it, to manipulate the system.
I'll be dark guy again for a second.
I was gonna say, I can go to the dark.
I'm willing to be that heavy for but why wouldn't you do that if there was enough money in it for you? Like, why would you care? I mean, in other words, if you could dominate the currency and you said, there are much more orthodox economic actors in the world who wouldn't care about crashing a currency to tremendous benefit to themselves. So why would someone who could say, I can make hundreds of millions of dollars, and it may ruin Bitcoin and the trust in Bitcoin forever, but I don't care.
It would be a really short-term gain, and I think it would. And you're lucky. It would take so much.
Like a bank robber.
To get. It would take. It would take a state. If you look at the amount of resources and capital you would need to take over 51% of the mining network, I mean, it would almost take a large state actor to do that.
So that was my next question. Why isn't a bad state actor going to want to do it?
Yeah. So I mean, like I said, I don't think, it's just my opinion, I don't think it's a realistic risk. I would be interested to hear other people, and certainly, people more on the technical side too can talk to this. But
my sense is the community is trying to police itself in this regard. And make corrections. And at one point last summer, when there was a potential 51% move, that the community reacted very quickly. I guess I'm curious to hear from the two of you, from where you sit, as to how that changes your view as to whether it's a centralized or a decentralized system.
Well, that's the irony, the paradox within it. It seems to me is that the technology can enable someone to make what was intended to be a decentralized system into a centralized system for their own profit, whether it's a state actor or whether it's someone else. And that seems to me to be a risk. It seems like someone did achieve 51% for at least a short period of time. And so that, that's a risk from within, it seems. So we wanted to save some time for some questions from the audience.
Lots of questions. Throw for you.
Just, sir?
Hi, I'm Mark Hochstein. I'm the editor-in-chief of American Banker. When a bank customer withdraws $100 in cash from an ATM and puts it in their leather wallet and in their pocket, from that moment on, the bank has no way of knowing what subsequently happened with that cash. If a Bitcoin user withdraws $100 worth of Bitcoin from a wallet at a company like Circle or Coinbase and puts it in a different wallet that they control, the wallet provider does have the ability to monitor what happens to that money after it's left the original wallet. Is that company, for compliance purposes, expected to do so?
So I'm going to give you my stock answer when you ask these types of specific questions. It's always it's a fact-based issue, and so it's going to depend on how that company is potentially organized. It's going to depend on how the transactions are occurring, but if they fall within that basic definition of money transmitter, we're going to expect them to comply with the obligations, having the AML program in place, the reporting requirements, the record-keeping requirements as outlined in the law. Being from an American banker, money transmitters do not have all the same rules as depository institutions, but they have many of the same rules. And so if they fit within the money transmitter definition, they're going to be expected to follow those rules.
This gentleman maybe down in front of the pillar on the right.
Hi, I'm Jacob Eliasov. I'm a Bitcoin entrepreneur. I just had a slightly more sort of forward-looking question about the future, especially for those of you involved in enforcement and regulation. Following up on something Jennifer was saying about forget good and bad, some of this stuff is just here and we have to deal with it. So let's suppose a few years from now, like even 10 or 20 years from now, there's a variation on Bitcoin and on these technologies which allows somebody in the world to send money or value of some kind to somebody else anywhere around the world completely anonymously, much more so than Bitcoin. My question to you is, would that be like, oh my God, like this is a real threat to society. This is, we might just have to crack down and shut down that technology. That would just, the criminals and terrorists would take over very quickly. Or would it more be like, that's a shame, that takes some tools out of our toolbox, but we could probably adapt just like we adapt to email and other technologies.
So it depends, right? So we're all about transparency for the purpose of fighting money laundering and terrorist finance, but there's ways right now, the $100 in the wallet example, if you hand a $100 bill from one person to the next, we don't get reporting or information on that. But if you take $10,000 in cash over the border, we should be getting some reporting on that. So it kind of depends on what's created. We're going to be looking at what's created. Is there a way? Does it fit within any existing framework? Can we make it fit within any existing framework? Can we create a new framework that will achieve the same ends? And if not, then we're going to have some pretty big concerns and would need to think about what's the policy response to that type of a situation, both domestically and globally.
I think this from a law enforcement, and I'm not in law enforcement, but from a law enforcement perspective, this technology cuts both ways. I mean, obviously, there's elements of anonymity. There's ability to transfer large sums of money and very, very quickly across borders, and so that's challenging. And so the challenge with any other type of law enforcement or regulatory framework is to be able to follow the money. Mm-hmm. And so I think there are elements of this technology, the public ledger, the general ledger, the blockchain, ways that you can follow the money. And then if you have registered MSPs, like a company like Circle and Coinbase or whatever, then you have more of a hook and a way to catch the bad actors. And so I think those are the tools that I think regulators and law enforcement needs to make sure this is a legitimate system.
I mean, that's absolutely true. Right? Someone used the analogy to email and things like that. Emails become, you see that every day, one of the great pieces of evidence that never was preserved before because they used to be in-person communications or telephone calls, and unless you had a wiretap, you have this permanent record. So the technology and the blockchain and the identification of transactions, maybe not the identification of the people, there have been a lot of things that are very, very helpful to law enforcement with the new technology. So we're not at all against new technology. It just has to be, we're in favor of it. It has to be designed in ways, there are ways to, obviously you can hand carry money all over the world and that gets done. Every minute of the day there are people carrying millions and millions of dollars and that's completely anonymous. But there still are laws. If you were transferring money across the world, those relevant nations have laws that say you have to declare the money coming in. So it doesn't matter that the technology allows you to do it in a certain way. The laws are the laws, and that's what the people want ultimately, at least in the United States, is the voice of the people should be to enact laws that are sufficient to the task of technology for the level of security and level of freedom you want. That's a decision not for prosecutors and not for regulators. That's presumably the beauty of democracy. You decide what is my balance that I want of security versus freedom, and that's some of what we're talking about today. This lady right here.
Chitrat with the Global Center on Cooperative Security. It's good to be here. So my question is around this exciting area of financial inclusion, which I think we're all sort of eyeing in terms of potential. And we've been following this debate about MSBs and the de-risking and sort of this whole areas. And this discussion about a risk-based approach when it comes to sort of the highest risk jurisdictions. And what about going back to this rules-based idea about the highest jurisdictions when you look at point-to-point transfers? What is sort of the value of maybe revisiting a rules-based approach to just be crystal clear about what it is that MSBs and crypto and currencies have to be doing to be compliant when sending money to particularly high-risk jurisdictions?
So I don't think the challenge in the high-risk jurisdiction arena is really about rules-based versus the prescriptive approach. The challenge is about the fact that you have high-risk jurisdictions that do not have anti-money laundering and counter-terrorist financing controls within that jurisdiction that are very good. And the risks around, no matter how good a system is built by the U.S. financial institution, they may not have confidence that when that value or money makes it to the foreign jurisdiction, that it's not going to end up in the wrong hands or end up being somehow else a risk that that institution just doesn't want to take on, whether it's from a reputational risk standpoint or an AML risk standpoint or a business cost standpoint. So it's really not about rules versus prescriptive. It's really about trying to get a handle on jurisdictions that aren't able to have strong AML compliance within their borders.
Yeah, we have any number of defendants every day that we talk about in our office that we know what they did. We may have them charged, and it's a sealed document, so it's not public, and we know that the jurisdiction that they're living in, and they're doing this on purpose, will never help us get them. We'll never turn them over, and we have to wait and see if they travel somewhere where we can grab them. But I mean, these are real problems with jurisdictions, you know, and they won't give us any evidence in a lot of jurisdictions, and those people are causing harm here in the United States, or we wouldn't be charging them. So you know, it's a big problem. You know, if the jurisdictions won't work, that's why I asked the question about foreign partners. This technology allows you to rob a bank, you know, from Estonia, you know, in New York. And Estonia's a bad example because they are helpful, but there's just a lot of guys in Estonia who do it. But you see my point. This lady here.
Earlier today at an event, someone mentioned sanctions against countries like Iran and Russia and not being able to use the SWIFT system. And I was just wondering how quickly the laws are going to catch up so when they use the alternative system, you guys are able to continue to use those kind of economic sanctions.
Hopefully very quickly. But that's one of the challenges is to adapt as evasive actions are taken, whether it's by individuals or entities or nation states, is the challenge is to adapt the regulatory system.
This gentleman over here on the, right there, yeah, you. Yeah, you're getting it.
Oh, okay. Hi, my name is Daniel Winters, a Global Tax Accountants. So my question is specifically about the requirements to file an FBAR, a foreign bank account report. So for 2013, as I understand it, FinCEN did not require the FBAR to be filed for balances outside the United States of virtual currency accounts. So if that $10,000 trigger was met, this rule, that applied just for the fiat amounts. So my question is, what about 2014?
Good question.
need
So
the
we have the
IRS.
FinCEN Resource Center. If you go to fincen.gov,
Okay. Don't tell me I missed
you will
something.
get the FinCEN Resource Center phone number and email address, and we have people standing by to answer that very question. I'm sorry, it's just a level of tech.
Your call is important to us.
Yeah. We do seek to answer all questions within 24 hours, but yeah, I'm sorry, I just don't know the answer to that.
This gentleman in the red here.
Hi, Eric Anderson with Bloomberg, and also I'm a representative from W3C, which is part of the largest standardization body when it comes to technologies. Part of this effort is some of the largest tech companies in the world, and all the way down to the Federal Reserve too as well. And hello again, Jennifer. Talking to you. So first, a statement to Circle. I completely disagree. There's a lot of technology companies that are looking at how to use cryptography and the public internet for transfer of payments, irregardless of Bitcoin itself. And second of all, as I discussed with both Benjamin Losky and yourself on there, the technologies exist right now to be able to provide standardization and regulatory points within a technology framework to be able to counter, terrorism on there and financial services and reporting on there. Is there any direction on establishing basically a tech side or a cyber side for FinCEN itself?
A tech side, I'm sorry, explain that last piece more.
A tech side or a cyber side of fintech, so they can actually start getting involved in the technologies and provide regulatory points and also standardizations for the technologies themselves. You can automate reporting, you can automate compliance, you can automate KYC and provide digital identity to the people in the public, so then you can pretty much be guaranteed the authenticity of the transaction really came from me. At Bloomberg, we secure billion-dollar transfers using technology.
Okay,
and
so your question is she doing that?
Yeah.
Yes.
No offense, but I want to.
Yeah, so we cannot be as nimble as you guys out there in the entrepreneurial world. We live with something called the Administrative Procedures Act. And so when we want to say to companies out there, you all need to use this standardized technology because it'll make everyone's life better, we have to do something known as the rulemaking process, which is the way to get regulations made. It is truly like making sausage. So we work with industry and others to get as many smart people in the room as we can think of, come up with an idea that sounds like it's going to be a good idea. We write what's known as a notice of proposed rulemaking. We put it out there. It allows for public comment, just like the bit license, and then you get everyone from the woodwork comes out and attacks why it's not a good idea, which is okay because you can make it better, except no two people agree. They all have polar opposite ideas. So we try to balance all these ideas and get to the right solution. And that process takes years. So from the standpoint of, are we thinking about standardized technology? Are we talking to industry about that? We are, but it doesn't tend to be quick to come. And there are costs and associated with it, particularly for existing industry to ask or demand through rulemaking a huge global financial institution to now change its entire technology base is not a small cost thing. We have to also talk in our regulations. We have to say how much the costs of any regulation are going to be, and that drives how fast something can move and whether it should move, rightfully so. And we need to keep in mind, if we in the United States say we want this standardized technology, what if another country wants a different standardized technology, and what effect does that have? So then we need to start thinking globally, and we are thinking globally and talking globally about that. So we're trying to figure out how can we do that the easiest way possible, because it just makes sense to have standardization. It's just very hard to achieve.
Democracy is a little clunky.
Yeah.
So I think we have time for one more question.
Jeff Thomas. I do work for a big bank, and sorry. And so my question relates to where this conversation intersects with civil liberties, because it was mentioned on the panel earlier that if you go to Target and you spend your money. And I would argue that because of what was said earlier, you can go to the ATM, you can take out cash, and you can spend anonymously in small amounts. So what about when we want to spend more than $100? We have this $10,000 limit currently that regulates how cash is spent. What's attractive about Bitcoin and cryptocurrencies is that you could then increase those limits. So when it comes to civil liberties, are we to say there will never be a point where you can make large money transfers without your employer and the government knowing what you're doing?
So I think Rich made a good point there. It's a balancing act between security on the one hand and privacy concerns on the other. And that's where governments, and in our case a democracy, comes in and decides what is that appropriate balance. There are plenty of folks out there in the business world and the public who I hear from that think we should get rid of limits and have reporting on all transactions, so no threshold, which would mean we'd be bringing it down. There's others that think everything should be at the 10,000, and there are yet others that think it should be even higher than that. And there's good arguments for all of those. So we do have protections in place to try to take care best we can while dealing with the security issues, the civil liberties and privacy of individuals. So at FinCEN, we collect all kinds of data, but that data is protected from unauthorized disclosures by both civil and criminal law. We do have criminal investigative agents at FinCEN who investigate unauthorized disclosures of people's private banking details, and we have testified at cases where folks have gone to prison over such disseminations.
I think it comes down to, I think obviously civil liberties are important, but it comes down to obviously security and safety. And so I think every one of us is, doesn't feel bad about getting, going through security in airport because we want to make sure the plane arrives on time, and there's a safety issue there. And it's the same thing with the financial system. If you had the opportunity to see some of the things that FinCEN and the law enforcement sees in terms of, terrorist financing, human trafficking, some really bad stuff. And so there needs to be some way, I think, to draw the line in the sand and catch these people. But it is that constant balancing act, is what's too much, what's kind of over the top from a government perspective.
And actually, it's interesting. I think France is going through this right now. They have very strong data privacy controls in Europe and in France in particular. But post-Paris attacks, they're going through a national conversation now about how strongly they feel about those data privacy controls and whether they want to loosen them, because now they're very concerned about collecting information related to terrorism. So
right, they even proposed the version that got voted down, but of a Patriot Act for them, similar to what happened after 9/11 here.
If I might add one little piece to this, is that in the money service business world, money transmitter world, that there are states that have imposed record-keeping requirements that are lower than the federal statutes. And in Arizona, for example, it can be as low as $500 where customer information is collected. Also, just a little footnote on the issue of privacy and reporting requirements and so on, is that I think a lot of people have forgotten that the former governor of New York got caught was the subject of a SAR ultimately in connection with a transaction that ultimately led to his, I guess, downfall.
And on that high note for democracy, I think we've finished our time. Thanks a lot.
Thank you.
That was great job.
Yeah.
everyone will be starting in about 4 minutes. Just a heads up. Thank you.
Please take your seats so we can get started on our third panel. Please take your seats. Welcome back, everyone. We're going to get started. Please take your seats now. Thank you. Thank you for taking your seats. So let's just dive right in here. This is our last panel of the conference, and please stick around for a cocktail reception to follow. We heard in our last panel a little bit about what keeps policymakers and regulators up at night on this topic. And I think we're going to go a little deeper here and hear about what the average person or the investor or consumer should be thinking about, what should be keeping them up at night, and the area of privacy, fraud, and other areas of consumer protection. We have the moderator over here on our left, Chris Skinner, chair of the Financial Services Club. He will lead a discussion with Michael Casey, senior columnist, global finance at the Wall Street Journal, in the middle. Sorry, I'm going out of order here. Scott Ellison, senior director of corporate strategy from PayPal. And Marco Santori, Global Policy Counsel at Blockchain. Chris, it's all yours. Thank you.
Thank you so much, and thank you for staying, for those who have. I'm going to give a reasonably lengthy introduction because it'll give time for the others to come back into the room and hear the esteemed opinions of our panelists, but equally because I've got quite a lot of interesting things that I'm observing around what's happening in this space. You can tell by my strange accent that I'm not American. I'm a Brit. The club that I run is a European networking club that operates in 8 countries across Europe, looking at all aspects of technology developments in financial services and in particular what's happening with the blockchain and cryptocurrencies. I also travel extensively, so I've just been in Africa, Bangkok and Dubai, looking at cryptocurrency and other developments as part of the observations that I'm picking up around the world. And I guess I wanted to say a few things about what I've heard on the panels so far this afternoon, because there was a reference to its early days. And Satoshi Nakamoto's paper on cryptocurrencies and Bitcoin was posted in November 2008. So this is just over 6.25 years old. And it's a baby. It's something that's growing into something that, is it a monster, or is it going to be something that's actually part of the core mainstream fabric of life? And you probably have your own opinions. I've heard quite a few opinions this afternoon, but to me, the early days comment is around, we started with an internet of access, which was revolutionized by Tim Berners-Lee with the World Wide Web that led to Netscape, AOL, Chrome, and now we're in the age of access everywhere, ubiquitous Internet of Things. We then moved into the second phase of the Internet of Commerce, where we saw fledgling companies like Amazon coming into play to provide commercial services on the Internet of Access, and that model gradually grew into something that's now big business. Then we got into the Internet of Relationships, where social technologies, the Facebooks and the Twitters of this world connected us easily, much more easily than Friends Reunited and Friendster and the stuff that went before. And now we're into the Internet of Money, or the Internet of Value Exchange, and I think that's where we will struggle to begin with, because money and value exchange is a area that needs regulation because it's got a lot of criminal interests in that space. And so we've had 2 panels, and this is the third, where we're really looking at how to regulate this early days fledgling space, this baby, and make it something that's actually workable in the mainstream. So the first panel was talking about how to make it mainstream. The second was talking about how to deal with criminals. And this is going to talk about how to protect the customer, the consumer, because most consumers are not that confident with money, and they can be easily and gullibly ripped off, as we often see. Mt. Gox being a case in point, where a lot of people lost money. I'm going to shamelessly just plug my book. Always have to plug a book, don't we? This is called Digital Bank. It came out in September, and in 4 months has sold more than my other 10 books combined that have been around for 10 years. So digital's a hot space, probably because it's got a Bitcoin chapter in there, plus a few others. Everything that's a book on cryptocurrencies and Bitcoin seems to sell a lot. But the theme of that book is actually that we built a financial system in the last century for the physical distribution of paper in a localized network. And then we cemented that system in place by putting technologies, starting with mainframes, to reinforce the physical distribution of paper in a localized space. And now we're dealing with the digital distribution of data in a globalized space, and it's challenging us because we're seeing digital assets being traded in a new form, and cryptocurrencies is the new backbone of that digital age of value transfer through the internet of money, the internet of value exchange. And that's why when we heard in the last panel opening about Bitcoin Ponzi schemes being used for drugs, terrorism, and pornography, and the Silk Road, and it's all scary. When you're in a fledgling environment where there's a new form of value exchange, it's always scary. You know, it's always going to be something that challenges us in our lawmaking and thinking. And what's quite intriguing is if you look at any progression of the internet, it's all pretty much been driven by pornography, games, and gambling. You know, it's a fact of life. I mean, it starts typically with gaming, and before you know it, gaming leads to gambling and pornography. And there's many examples that I could give, and I don't have time, but the QQ coin in China is a great story that illustrates it very well, because it started as a virtual currency for kids to download ringtones and soon being used for chat rooms for intimate conversations and gambling. In fact, when PayPal was bought by eBay, and you may reflect on this, Scott, but people tell me that over half of the transactions were quite suspicious in their usage at that time. I don't know if that's true, but I've heard
that's
various
before my time. Sorry.
It's before your time. But eventually these things become legitimized because we learn what's taking place and how to use them. And I'm involved at the moment in quite a lot of cryptocurrency roundtables in the fintech center of the world called London. I'm biased. So is Boris Johnson, who's just been here, the Mayor of London. But if you look at what's happening, I think particularly the technology of Bitcoin, forget the currency, the technology of Bitcoin is starting to become mainstream. And we've heard that a little bit on these panels, but we saw BBVA, New York Stock Exchange, USAA invest in Coinbase $75 million just last month. I'm involved in a tech mentoring accelerator with Barclays Bank in London, where they have 10 cryptocurrency development companies working under their mentoring and nurturing. You saw banks like Bank Inter, a Spanish bank, investing in Bitcoin and cryptocurrency startups. You've seen Richard Branson, who's one of our flagship people, but you've got people like Reid Hoffman, the founder of LinkedIn, Mark Andreessen, all saying that this is a revolution in payments and a transformation in the way in which we think about money. Bill Gates is saying this is going to be the way in which we're going to actually enable cheap mobile financial inclusion for the world, so that 7 billion people now have access to financial transfers and value transfers they never had access to before. And it's all based around the idea of using the blockchain, smart contracts, and side chains around the blockchain to build new value structures and new exchange systems. So I think the real concerns that we haven't addressed in the other panels, and I've covered a little bit about what's already been covered, but I think the real concerns right now is the volatility and liquidity of the marketplace, because that's causing a lot of people to lose money, or equally some others to gain money very quickly, because if you pump $1 billion into the Bitcoin ecosystem, you're going to make the value shoot up very quickly. Equally, if you sell $1 billion, you're going to shoot down very quickly. The whole area of fraud protection, because a lot of people did lose money with Mt. Gox, but it's not just Mt. Gox, there's lots of other examples where people are losing money just by, for example, in one of our papers, a headline the other day, where someone threw their hard drive into the rubbish bin and didn't realize it had all their Bitcoin wallets on there. Stupid. So how to protect the average John and Joe, and John and Jane rather, on the main street from being ripped off. So there needs to be probably some form of FDIC for Bitcoin and the cryptocurrency markets. And what is that? And how do you create that? Is that what we need? And I guess in my final contemplation, before handing over to Bruno to start the conversation, Marco rather, to start the conversation, is that, do you remember Second Life? Mm-hmm. Do you still talk about it? We don't. And I know that some guys have heard me speak before, but I always come back to this one because Second Life went into meltdown because George W. Bush brought in the, well, not him, but his party, brought in the anti-gambling regulations over here that said if you were providing online gambling, you'd be thrown in jail. So everyone moved to Costa Rica and Guernsey and other places and created online gambling services for America there. But Second Life decided that they had to close down online gambling in their world because it might get them thrown in jail. And it caused a virtual run on their virtual banks for virtually 24 hours until something happened that was quite amazing, which is the banks disappeared. Ginkgo Bank being the largest because Ginkgo Bank was run by a 32-year-old student in Sao Paulo, Brazil. And when he saw that there was a huge run on his bank with real dollars going out, and he had $1.5 million US on deposit, he thought, well, my Ferrari and condominium is going to have a problem here, so delete, and just disappeared. So the virtual community of Second Life for 3 months virtually demonstrated outside the virtual headquarters saying, give us our money back, please. And the guys at the Linden Labs headquarters said, do you know what, there's a problem, we don't know how to deal with this. And eventually they dealt with it by saying, if you're a virtual bank in our virtual world, you have to have a real bank license in the real world. And to me, that's the fundamental core of what I think from a consumer protection side might be the cryptocurrency development. Because if, for example, we don't legitimize and regulate the use of cryptocurrencies on US domestic soil, then you're only going to see Guernsey, Malta, Costa Rica and other countries offering services that will enable that transfer to take place legitimately outside these shores. You may or may not agree with anything I said there, but we talked about a risk-based approach, KYC, cybersecurity, and the protection of people so that they don't have to go elsewhere to find their cryptocurrency usage. So have I said anything that you totally disagree with, Marco? Or?
That is an incredibly robust question. No, look, it's someone who actually just spoke before me coined the phrase that Bitcoin is a baby in its crib and we don't know what it's going to grow up to be. And I think that's really accurate here. We don't yet know how these risks that have really presented themselves through the history of money are going to present themselves in digital currency. We see some today. We've seen consumers lose money. We've seen consumers make a lot of money. But we don't know just how that's going to occur over the next 5 years. In fact, had you asked me how might consumers lose money 3 years ago in digital currencies, I probably would have said, what are you talking about? Why would consumers have any significant amount of money in digital currencies? 3 years from now, I can't imagine what I'm going to say. And I think that's where most of the criticism of new regulations, of new lawmaking comes from. There's merit there. Mm-hmm. It's difficult to really put our arms around what the risks are going to be. And when we're making law, when we're making new regulations, they have to be elastic enough to deal with that new stuff. But at the same time, if they're too elastic, you have the problems that some of the earlier versions of the new regulation that's been introduced had, which is speaking in metaphor. And that's how you write a law that's elastic. That's how you write a law that can apply in a lot of different circumstances, is by writing a law that speaks very sort of generally. But at the same time, when you generalize, you lose specificity, and new entrepreneurs in the space wonder, well, gosh, what does it mean to take custody of Bitcoins? I have no idea. I don't hold Bitcoins. I don't use my hands to hold them. What does it mean to hold them? And if that's the kind of thing that's written into a law, I think we can expect real trepidation there. And there's not an easy answer to it.
No, and I guess the fundamental challenge is how do you protect consumers from something that's completely decentralized and just out there in the net? I mean, Michael, from what you're seeing and reporting, are you picking up any illustrations of how different governments or different organizations are providing a consumer protection service, or is it just Wild West?
Certainly on the organizational side, the government approach around the world is completely varied. The thing that I find sort of at the nub of the question is to what extent we should treat this as something that is the responsibility of the user. And if that's the case, how much the goal is actually education, because you don't throw your hard drive out, right? And you also make avail of what is really some quite remarkable technology that's being developed. I mean, in some respects, Mt. Gox was a wonderful boon for developers in the cryptocurrency space because they've developed some fabulous security measures. There's multi-signature wallets that are out now that really are cutting edge in terms of the capacity to really make it very difficult to break into. But that said, the average Joe or Jane is not necessarily comfortable with holding so much value and securing it themselves. So then you look at what's happening, and we had Circle earlier telling us about the fact that they've got insurance on their custodial provisions. Zappo as a really interesting to the extent to which they've gone. They've got like vaults in the bottom of Swiss mountains and old nuclear bunkers to store the keys in multiple locations just to protect their custodial holdings. And as a result, are able to get insurance. Coinbase has got, I think, a portion of their cold wallet Bitcoins insured. And that really speaks to if insurers are coming out and sort of ensuring that there's a degree of confidence that the technology and the provisions that these kinds of companies are taking is pretty solid. And so that is the sort of thing that could bring you into having people feel comfortable. But then you get those other questions about, well, you're a depository institution. How should that be regulated? And what is the relationship now between the consumer and that provider of custodial services? Maybe that's where an FDIC sort of institution comes in, and then it's that nexus between the degree to which the goal of, for many people, I think, the sort of more libertarian side of Bitcoin was to create a bank in your in your pocket that you could control yourself, and the division between, say, the way blockchain wallets work versus Coinbase wallet works speaks to that. So I suppose it's how the market evolves and what it is that people are going to want. But there's certainly, I've found there's a lot of education that can be done. So since you were plugging a book, I'm going to plug mine. My colleague Paul Vigneault in the audience said we've just written a book, and so very pleased to know that yours is doing well because of cryptocurrency. Ours is called The Age of Cryptocurrency, and we're actually selling it here tonight. So, but the reason, my segue from that back to where I was is, in doing so, there's this sort of educational element that I think is really important for the consumers.
Yeah, in fact, that's a key point, and Scott, you can probably pick up on it, because we talk about consumer protection, but right now, Bitcoin isn't a consumer technology being used on mass markets. It's some people would say geeky or nerdy start technology, which hasn't entered mainstream. Is that the case, or are you really feeling people banging on the door saying, PayPal, we want to use Bitcoins through your wallets? I mean, what's happening from your perspective?
Yeah, I think that's a really great question. We talk about this being very early days. In fact, it's only really about 10 months old from a consumer perspective, and it dates back to March of last year, where someone thought they unmasked Satoshi Nakamoto's identity, and it was supposedly some guy in LA, and he got the full Kardashian treatment for the next 3 days of literally people chasing with helicopters, and it was on TMZ, and it was on Entertainment Tonight, and then it was the cover of Newsweek, and I think that was the first time your average consumer even heard of Bitcoin. And since then, in some ways, the volatility of Bitcoin's price has helped protect it against people adopting it too quickly, because they see these price variations and they're not ready to accept that level of risk. And then from a PayPal perspective, about I think it was September, we partnered with 3 wallet providers to begin facilitating Bitcoin payments through PayPal, but restricted to digital goods, things like games and ringtones and movies. And we chose that category very specifically because that was one of the first categories of goods people began purchasing on their phones even before the iPhone. So it's relatively low cost, and the risk of not getting the Beyonce soundtrack, or even more of a $40, $50 purchase like a full season of Game of Thrones, is a little less. And one of the reasons that we actually decided to do this, even though we weren't necessarily seeing a huge amount of consumer demand, was that we talk about merchants and we talk about consumers, but we also talk about developers. And it was a response to a lot of the developers, and being based in Silicon Valley, where developers were asking us to help support that. And then I'll just end on the thought that we're beginning to think about Bitcoin, that it's the bit part of Bitcoin maybe actually more important than the coin itself. And we're beginning to see a pivot of some of the major investments that are being done, especially in Silicon Valley. The wallet providers are still getting big rounds of financing, but we're seeing more and more investment turning into like alternate chains and other things you can do that aren't necessarily a financial transaction. And we think those should be regulated potentially very differently.
Yeah, I made the point that the currency itself is probably more irrelevant than the technology. Is that what you're seeing as well?
I think directionally that's probably where we're going. I'm relatively, my background, by the way, I only joined PayPal 2 years ago. I spent 25 years in the mobile industry. And in fact, I graduated with a foreign affairs degree at the concentration in Soviet studies in 1989 and timed it perfectly because the whole Eastern Bloc collapsed 6 months later. And then I had to do something else. So I went into, no, but I did read it on the way out. But the broader point being that when we've gone through, having gone through the mobile industry and the changes that we've gone through, a lot of these concerns, anti-money laundering aside, feel very familiar to me. 10 years ago, when the first GPS chips were being put into phones, there was enormous concern around things like stalking and people tracking down your children and kidnapping them. And those were actually reasonable concerns for the time, but they largely didn't come into play because the industry became more about the bigger players who acted responsibly. So for instance, PayPal, we only partner with wallet providers that do anti-money laundering, that do KYC, and that's one of the ways that we're trying to move the needle on that, but do that in more of an incremental, consumer-friendly way.
Maybe I can just respond to a comment that I heard you make. Are we seeing a shift away from Bitcoin the currency to Bitcoin the technology? And I can tell you in my practice, I'm a lawyer in private practice. I've seen the sort of the new wave of new matters that are coming in the door, seeing more and more of this so-called Bitcoin 2.0 stuff, using the Bitcoin blockchain for things other than a money, other than a currency. Smart contracts, chain of title are the sort of common examples. But I think it's a very common misconception, and I hear this stated all the time, and I confess I said this when I first got started as well, is that, look, I don't know if we're all going to be using Bitcoins in a few years from now, but it's Bitcoin, the technology, that really interests me. I think we're going to have the Bitcoin technology get a lot of traction, but almost no traction with Bitcoins, the currency. And that is, I now realize, a fundamental misconception of how the technology works. You cannot have the Bitcoin blockchain. It cannot be used. It is not a useful technology without the currency, without the Bitcoin currency. The Bitcoin currency, the block rewards that actually incentivize miners, who are the payment processors of this technology, that's what incentivizes them to do the thing that Bitcoin does so great, which is verify information embedded into the blockchain. So without the technology, without the currency, we do not have Bitcoin technology.
Just on that point, I'll come to you in a second, Michael, but just on that point, one of the things that people tell me is that you can't really use the blockchain anyway for mass currency volume transactions because it's not scalable because the limit's on 10-minute refreshments and 7 transactions a second. Is that a physical issue, barrier?
No.
Okay.
No, I think that's a lot like, that's a lot like looking at a kid's tricycle and say, why do you even bother learning how to ride that? You're never going to be able to ride in the Tour de France. That's crazy. Well, no, maybe not today. Of course not. But that's not necessarily the case in a year from now and 2 years from now. And I'm an attorney. I'm not an engineer and a technology guy, so I won't go too deeply into this. But I will say that Bitcoin is not even at 1.0. This thing is building, it's living, it's breathing, it's being constructed. And to say that it just doesn't have the chops to operate as a global currency, as a global network. Well, somebody just said very, very publicly, so I'm very clearly copying this guy, but somebody just said, when a genius points at the moon, the fool looks at his finger. And that struck me this morning. I think I read it on Twitter or something, so I'll retweet it the old-fashioned way. And I'll say that, so saying, look, Bitcoin just doesn't have the chops to be a global currency is not even looking at the finger. That's somewhere between like the shoulder and the elbow.
So, Michael, you were going to add?
Well, I was just going to weigh in because the whole currency blockchain thing has really become something of an issue of late. Because I think Mark is absolutely right. There's just this instinct to sort of just say, oh, I'll just take this piece and not that piece. But I will say that my take on this, because it's relevant to the way that we've positioned, the book and the stuff we've written about. Working at the Wall Street Journal, there's just the narrative has been wrong around Bitcoin, and I think that what's happened is therefore there's been, because everyone was focused on the currency as if it were something separate from the technology, as if all that mattered was some digital representation of a banknote. And that's, they talk about the average person's understanding. They didn't know what the ledger was, they didn't understand the blockchain, they didn't understand the whole idea of what the private-public key process was, they just thought of it as if it was like some strange digital version of this, and they also knew that there were a lot of folks who thought that it was going to take over the world and destroy every other currency and kill the Fed. And then when it didn't, and when the price fell, everyone was, well, see, it's useless, it's dying. And to me, that was like, well, that was because we didn't properly build the narrative around the fact that the technology is incredible. The technology is
the trough of disillusionment.
Right. Well, now we're sort of trying to come out of it, but I think the story has to be around the technology. It has to be, this is what it can do. And of course, you can't have it without the currency, but somehow there's a meeting of those two positions that requires the average Joe to start thinking about what it is that get these people excited.
And Michael, I don't know if you feel the same way, but I've been fascinated as a I used to be a regulatory lobbyist back in the day for the mobile industry, and it was fascinating to me in just the last 2 years, especially when the Silk Road story started coming around. There was a high degree of alarm among public policymakers for understandable reasons. And then it was remarkable how quickly it became a much more nuanced approach around the possibilities of the technology. And when you look globally so far, from my perspective, the regulation has been relatively light. You see people kind of holding back and not wanting to necessarily over-regulate too quickly because they understand. There's a public policy understanding of what the potential technology can do.
I think the FinCEN moment that was alluded to in the previous panel as well was it was critical because that panel and the paper that they brought out, it did seem as if people there were actually reading beyond the headlines, forgetting about the alarm and recognizing that there was something to it. It didn't stop the alarm in the general public from continuing, mind you, because then we had Mt. Gox and Charlie Shrem and a whole lot of other things. And that's still I would suggest the mainstream view is that this is a scam or some sort of weird Ponzi scheme. I mean, that's the general view, and there's still a battle, despite the fact that regulators actually seem to be better informed.
I kind of wonder whether it's like any new technology progression that we've seen in the last 30 years, particularly from a consumer's perspective, that the media picks up on what's scary about it and says, oh, the internet's all about pornography and it's all about terrible sort of illicit activities. Oh, Facebook's all about child grooming, don't go there. And eventually everyone realizes, no, this is actually just a good thing. Is that what we're going to see?
I think so. I really like the point you made about the sort of early adopter role that pornographers and criminals play, and it's like it's a sad fact of life, but it certainly is the case of the internet. And we were thinking about this when we wrote about it. It was like, well, really, okay, so would a drug dealer want to trade in a currency that was worthless? No. So they're putting it to the test. And of course, they've got maybe a little bit more of a buffer that they're happy to work with in terms of volatility, because that's the premium they're going to have to pay for being criminals. But at the same time, they wouldn't. They were out there kicking the tires of this thing and testing it. Then they get caught and we move in. And it's an interesting and maybe an unfortunate progression that gets there. But we sort of move through these technologies in that regard, and I think you can probably assign the same process to technologies going right back through history.
It's already part of it's already part of board conversations across different industry sectors. This is now public, so I can talk about it. But we had a June board meeting at eBay to discuss Bitcoin. And on our board includes Mark Andreessen of Andreessen Horowitz, who founded Netscape, and he's one of the major funders of Coinbase, which is one of the big Bitcoin wallets. We have Bill Ford of Ford Motor Company, and Scott Cook of Intuit. And without going into the details, I got to be the one to actually do the presentation. It was a lot of fun, and it was a very sophisticated conversation about all the different things you could potentially do with Bitcoin. And then it got cited in the Wall Street Journal as the point at which our CEO, John Donahoe, changed his mind about potentially spinning off PayPal, and now we're getting spun off. So I wasn't there for that part of the conversation, but it was interesting, just the level of sophistication of understanding across different industry sectors of what this potentially represents. And it goes far beyond the coin part, but that's also part of the beauty of it. It's a self-funding type of ecosystem.
I think I wanted to build on a point that we exchanged on email, actually, and then see what Marco and Michael can add to the conversation, because I was at a Bitcoin conference about 2 years ago, and I've been involved in tracking this for probably about 4.5 years, but I regularly get into an argument with the Bitcoin fundamentalists, and there's many of them out there, maybe someone in this room for all I know. But the fundamentalists will say this is created as a decentralized currency value exchange that is not government, it's not meant to be any government involved. It's money without government. And the argument I get into is you can't have money without government. And the reason I say that is that as soon as you have money without government, you can have consumers and businesses and homeland territories threatened by people funding illicit activities that include terrorism, etc., because it's not being governed. So how do you see this playing out from your side, Scott, in terms of, because you said maybe we're being too extreme in saying money without government. You can have money without government because this is out there, it's decentralized, it's there.
I think there's a couple of different aspects to that, and the farthest I can go, because I'm not on the public policy side of PayPal, is that I don't think it's a straight line from less regulation to necessarily terrorist financing. And I also think you have to figure out how do you actually convert the basic fiat currency to the virtual currency or digital currency, what have you. And so we've been on the record now in an Australian proceeding saying essentially the same regulation should apply in a technology neutral way to the same category of players going forward. Because if you're looking at those types of issues, it's not that different at the end of the day from buying a diamond and sending it via mail and then someone just selling that elsewhere. So I think the initial concerns around AML are very understandable, but it's really not that different from any other forms of people transferring value.
Marco, I mean, is this a decentralized value exchange that's ungovernable, or do you think it's going to be governed?
I can't help but shake the feeling that this is a lot of meteorology.
Mm-hmm.
This is a lot of climatology, and then we're studying this, and it's there. It is what it is, and it will change and be affected by the world. But at the same time, there's not a lot that governments can do to shape the core technology. There's not a lot on that front, but there is a tremendous amount that governments can do to shape the way that sort of law-abiding citizens use it. And it's funny, you brought up technology-neutral regulation. I don't know, but that's sort of a pet of mine, a pet project, a pet thought process of mine. We submitted, the Bitcoin Foundation submitted testimony to New York's Department of Financial Services when they were contemplating the first bit license, and really the theme of it was technology neutral regulation, and that the bit license didn't seem to be technology neutral regulation, and it is what it is now. We've seen a second iteration of it, but I think there's real danger there. I think there really is a danger in treating technologies and regulating technologies in a markedly different way than other technologies. I will say though that all financial regulation is technology specific these days. I mean, you look at the travel rule. If that's the hot issue around Treasury right now, and how it interacts with digital currency companies, and that was written for Swift technology. It was written for a specific kind of technology, and now what do we have? We got a whole lot of trouble applying it to a new technology for people that are doing essentially the same thing, but just with a new technology. Now we're tripping over ourselves to try to deal with this stuff. So look, is there an easy answer? No, of course not. And a lot of ways I'm just sort of highlighting the futility of it all and not providing a very good solution. But this is exactly the kind of, I think, the kind of approach that we need to take and the kind of understanding we need to have of the consequences of technology-specific regulation.
One of the theories I've heard is that governments will only regulate Bitcoin usage for cash in, cash out when you're going from your national currency to Bitcoin. I mean, Michael, is that what you see from?
Well, it's currently, I think the Treasury's position specifically is that, correct me if I'm wrong.
No,
that they were. I thought that they decided that they cannot regulate Bitcoin to Bitcoin transactors, or anybody that's only a Bitcoin only company. I mean, it might be falling under some other area, but the Treasury or FinCEN, for example, doesn't see a need to regulate. Is that right?
I think that right now what we've seen is an emphasis on the companies that are providing the on-ramps and the off-ramps, because those are quite frankly, those are the ones who are flying close to the sun. They're trying to achieve the new things and actually generate real revenue. They're one of the few companies in the space that are, and they touch the traditional financial system. Under the wording of the guidance, in fact, pure crypto-to-crypto exchanging, pure crypto wallet providers are in fact money services businesses. They're money transmitters, and there's a whole lot of politics, I would imagine, on who gets enforced against it, who doesn't. But I think that the important thing to realize is that, yeah, that's absolutely right. Where the emphasis is now.
No, and they've actually
is
explicitly
that
said that
membrane.
that's what they care about.
Yeah.
But the rules may be in that place. I think it was interesting the way that just to go back to the earlier question you made, again, we keep on breaking around technology and currency here because, the technology neutral approach treats Bitcoin as a technology, and then there's this question, okay, but if it is a form of money, does it get different treatment? And it sounds like that's just going to just be a never-ending, difficult to resolve problem. But I think we can also still look at the asset that it is and recognize that it is possible to exist as a traded entity, as a token of value apart from government. And for reasons that were cited, it could be just like a diamond ring being transferred somewhere else. And let's not forget that through history, when monetary systems and government monetary systems have broken down, communities have found ways to create and use their own money outside of government. I mean, when the early years of the revolutionary movement here and the British Crown. And of course I have to share their sentiments. As you would guess, my accent is not a British accent, for those of you who think I'm actually, but we didn't quite suffer the same experiences. But nonetheless, there was the British Crown held back the coin, and the settlers decided that they would start using wampum because that was, that they needed something, so it worked, right? So there's no God-given rule that there has to be government money, and I think it's an especially problematic issue for a currency that is traded globally, because I get the point that there needs to be regulation of whether it's the on and off ramps or just areas in which there's vulnerabilities for people and for the financial system itself. But regulating the money itself, it just fundamentally can't happen because it's not a government money. It's not being issued by governments and it's global.
Well, let's take a different angle because it probably isn't something that's well known here, but there's a bank that is about to open in the US, which I'm very familiar with because they've been in Germany for 6 years. And they see themselves as a digital value store. They're called Fidor Bank, F-I-D-O-R. And they're about to launch in America with a partner bank over here, so they'll probably have a different name when they launch here. But by seeing themselves as a digital value store, I mean, it's a bank with a proper bank license in Germany, but they launched with the idea of being for the post-Occupy generation that is disillusioned with the old system. So they do lots of really interesting, weird and wacky things. They're very social media oriented. But one thing that they say is, anything you see as a digital asset, you should be able to store with a bank because we've got a bank license. We'll guarantee your asset. So you can store euros, obviously, pound sterling, dollars. You can store commodities and investments, pensions and savings, and aggregate the whole thing so it's all in one window on your home page. You can store commodities, oil, gold, investments. If you've got gold and it happens to be World of Warcraft gold or Diablo gold, you can store that because that's a valuable asset in your view. And you can store bitcoins and cryptocurrencies in their accounts, and they're guaranteed because they've got a bank license. So when they launch over here, what I'm intrigued by is that maybe it's more to do with the consumer's view of how they want to be protected, going back to buyer beware. So if you're buying bitcoins and you're feeling, I don't trust this system because I saw Mt. Gox and all that other stuff, I'll go and put my money in Fidor Bank because at least I know it's safe there. Is that what we're going to see, do you think? Michael, I'll start with you.
Well, I mean, we do have the option of getting guarantees. It's just not guaranteed by governments, right? So you can hold your Bitcoin with Zappo, and they're going to guarantee 100% insured holdings. And these are fairly big underwriters behind those insurance programs. The same with Circle. So you've already got an insurance program. The question is, do people want it to be federally insured? And I think that problem arises more fundamentally in a fractional reserve banking system than it does in a custodial basis, right? So I don't know why you need a government-backed insurance plan if there's not a lending program on the assets that you're providing and storing with that bank. Mm-hmm. So I mean, it's a fundamental question about what a bank does. And once there's lending and it's fractional, then sure, you desperately need some sort of guaranteed program because there'll be runs on banks. Mm-hmm. But if it's just purely custodial, just independent insurance may just be sufficient, right? I don't know.
Scott?
I think I'd like to hark back to a point I think it was Brian made on the previous panel, but I think we should really look at, I think there are certain groups of people like millennials that this just doesn't matter as much to them in terms of they've grown up on mobile. They're much more comfortable just doing completely mobile banking. You never step in foot in the bank because you're never really doing much with it. You just go to an ATM or you just take a picture of your check to deposit it. And along those lines, PayPal owns an app called Venmo, which is growing explosively in its social payments. And we talk a lot about consumer protection and privacy, and this is almost the exact opposite. Venmo, you publish to the world who you're paying, what you're paying for. And I just read through my Venmo feed earlier this morning, and I was pretty shocked at some of the things that people were putting on there in terms of, you have a pretty good idea what people were doing last night, and someone else was requesting money because they had to do someone's dirty laundry. I mean, it was pretty amazing what you could see. And
I think I don't get Venmo. That's crazy town.
I agree.
Maybe I didn't think I was part of the generation that doesn't get it.
You're too old.
But I guess I'm starting to shade into that.
Well, where I'm going with this is that, hey, and I'll date myself, I'm 47, so I don't get it in some ways, but I know our numbers internally, and it's growing explosively. It was just named one of Time Magazine's top, I think it was #4 app of the year. And so as we begin talking about some of these things around protections and expectations, we can also see a millennial generation that frankly just doesn't care about a lot of this stuff. I was raised and kind of grew up in the mobile era where the two things you never go near are health is ultra private and financial information is ultra private. Now we're seeing a sense of financial privacy it seems to be literally dissolving in the next generation. And I think what you'll see with Bitcoin and things like decentralized trust, this is becoming a pretty normal thing for the generations coming right behind us.
I guess it's something we can't answer here, but going to your Venmo point, the stuff that's shared on Snapchat and other apps amazes me as well. And I guess it's going to be a perception view of the generation that's coming through, as saying, how do they see digital value exchange? How do they see value stores? How do they see these things? And they may flock quite easily to using cryptocurrencies and not care about the FDIC and the government regulation backing of that, because they just want to have the exchange of value.
I don't think it's just generational. I think that's an obvious point, and it's borne out by the metrics. But that's not all that's going on here. So I'm here on behalf of a company called blockchain.info. And what blockchain does is very different than what most service providers in the space do. Traditionally, and I'll sort of explain it by explaining this one point, in the Western world, we're very comfortable giving our money to somebody else and trusting them with our money. We're very comfortable with that. We give our money to banks, to brokerages, to all kinds of people who we believe deserve our trust and by and large have carried that obligation and sometimes not carried it. But that's not the whole world. Most of the world doesn't behave like that. Most of the world doesn't trust their money to somebody else, even if it looks really secure and it's in a building with granite pillars. It just doesn't speak to them. They keep their money. They bury it. They put it under the mattress. They put it in a safe. And those two competing metaphors, I think, have really informed a lot of the development of this space. We have the custodial service providers, the people who tell the Bitcoin community and people who use Bitcoin, trust us. Give us your money. We've got licenses. We've got a risk-based AML program. We have a whole lot of other things designed to ensure that your money is safe with us, so hand it over. And by and large, that's worked for some people. What blockchain does is a little bit different. The purpose of the blockchain software is to give you the tools that you need to secure your money yourself. And that is a metaphor that we believe is very popular in places outside of the Western world. Now, interestingly enough, and because there's some of these entrepreneurs here in the room today, there's this hybrid approach now that we're seeing, which you've heard referred to as multi-signature. It's really a little bit of both worlds. It's maybe a little bit custodial in a lot of ways, but really not custodial at all, because these multi-signature wallet providers can't spend your money without your permission. And we're seeing this sort of battle for mind share. And it may not be a zero-sum game. It may not be a piece of the pie. It may be that people want to use different technologies for different circumstances. But I think it's this battle of metaphors that's very powerful. And it's
you remind me of a final
space.
point for asking for questions from the floor, but it's something worth exploring with all three of you, that I think. But you kick it off, Marco, because maybe the whole thing will be solved when we get into having a good digital identity scheme. Yeah, we don't actually have a decent digital identity scheme right now, so actually it is still easy to find that you don't know who's a dog on the internet.
Yeah, I think that's true. And just a brief point about the sort of the elegance of the system as it stands now. The Bitcoin protocol is neutral, and so if you want to participate in a transaction that requires identity, by all means do it. If you don't want to, don't. It's user-defined privacy and user-defined identity verification in a lot of circumstances. And something I'm seeing in my practice is companies that are coming to me seeking guidance. How do we set this scheme up? How can we set up an identification protocol that will carry companies' anti-money laundering, customer identification protocol, and know your customer obligations? I think it's a space that has a lot of room to grow and a whole lot of runway.
And I mean, going to the point earlier, and I'll go to Scott, and then we'll summarise with you, Michael. But I've used PayPal for many years, but to begin with, I didn't trust it, so I just did small transactions, and then gradually I started doing larger transactions. But as soon as you get into bigger transactions, you go, who is it I'm dealing with here? On the other side, can I really trust you? Will PayPal protect me in that transaction? And so maybe going to digital identity, people use cryptocurrencies quite happily for very small transactions. As they get bigger, they'll want a digital proof point.
I like that we seem to be wrapping up around this point of digital identity, because I think it's one of the biggest issues. It's right below the surface in Silicon Valley, particularly financial services, because you have the payment networks, the Visas, the Amexes, and MasterCards have just come out with this new tokenization scheme, which scheme has a bad connotation here, but in Europe, scheme is just, it's a plan or a standard. And at the heart is around identity. And then you have this other parallel thing that's happening in the big tech space around identity and biometrics. And this is one of the most fascinating areas of how fast people are adapting to technology. Apple shared at their developer conference in June that I think it was 83% of all iPhone 5S users that have the capability of using fingerprint ID on their devices use it for locking and unlocking their devices. Apple uses the fingerprint ID for Apple Pay, and Apple Pay is a pretty beautiful experience. And living in Palo Alto, my short little story about this is that at my gym, which is the Equinox in Palo Alto, Peter Thiel works out there, and he founded PayPal, and Tim Cook works out there. And literally on Sunday, I went to the gym, and Tim Cook got on the Stairmaster next to me, and he had an iWatch, so he has a pre-production one, and I'm watching him and how he's kind of doing it, and you could actually see that it was measuring his heart rate and perhaps perspiration. We'll see what all the different sensors are out there, but those are other ways to authenticate people. And Google has already been talking about, because they feel they're a little bit behind mobile payments and fingerprint ID. They've said quietly, well, actually fingerprint ID may be archaic because we can tell from you carrying around your device and just the way you walk, we know it's you. So there's a really interesting aspect of that, and who's going to control identity, how does it get shared, who authenticates that, do you have to pay for that? And I think it's going to be one of the most interesting areas to watch for technology and financial services, and who ultimately has that trust to store and keep that safe.
I'm just going to pick up on that because it really is. And I think what I'd like to do is sort of locate the conversation in what most people, I think, often agree is one of the great use case possibilities with Bitcoin, which is the developing world, right? So, the big issue of the unbanked has precisely been the lack of identity. So then the idea is that, okay, and it's whether or not they have the documents themselves or whether the government is corrupt and hasn't been able to deliver them. And there's just no way to prove who you are. You can own your land and everybody knows it's yours, but you can't mortgage it and turn it into an asset as we can. And that just retards growth. And so unleashing the power of people's capacity to identify and prove both their identity and their creditworthiness has profound economic consequences. And so there's a big global economic possibility in this. But to Scott's point about this idea, but who owns it? Well, this is where blockchain technology starts to become really powerful, because if we build identities around these alternative measures, whether it's the number of times somebody goes from one place to another, and therefore we prove that they actually have a job, and we're watching their geolocation movements in that regard, or various other forms of activity. The concern is always that the centralized figure, whether it's Google or PayPal, if somebody owns your information, then can we trust them? Well, this is where blockchain comes in, right? To find ways to give people the power to recognize that they can give up certain amounts of the information where they need to, but they can withhold information at the same time because they control it. That's the power of blockchain, or one of the many aspects of the power. So you really have an interesting intersection of these technologies. And I think the stuff that's being done at the MIT Media Lab around digital identity and the way it's weaving into these opportunities specifically for the unbanked and the developing world is just super exciting.
Yeah, absolutely. I think I'll wrap up on that point just with one final thought from my side, because Bill Gates is pushing through the Bill and Melinda Gates Foundation mobile financial inclusion services, and is saying that the blockchain and cryptocurrencies is a critical part of making that easy and free and being secure and reliable as well. And there's some interesting things around a discussion on using the blockchain for the Internet of Things, and saying if your devices are all recorded on the blockchain rather than your identity, then it's your devices that become part of how you identify what's happening with whom. So when you sense and exchange information, that will be your identifier. And there's a great technology that I've just seen being trialled by Royal Bank of Canada and MasterCard, where similar to what you were saying, Scott, you have a Fitbit style wristband, but it monitors your heartbeat as your authentication, because everyone's heartbeat is unique. So you have to be breathing to open your bank account. You have to be alive. And it's a really much better secure way of identifying people than maybe giving a username and password.
But you could still be a dog, presumably.
A dog with a very good heartbeat. Right. Are there any comments or questions anyone would like to raise? Yes, sir. You had your hand up first, so I guess microphones might be coming around.
Hi, Micah Winkelspect. I'm the CEO of GEM. So I'm what he's probably alluding to as one of the entrepreneurs who's working on multisig. So we provide multisig wallets to developers to build into any type of blockchain app. And so I've noticed that there's a huge gap in understanding between policymakers and the technology, especially as it relates to multisig, because most of the policy that's come out has assumed either a model of an individual holding their own assets or a custodian model of holding assets on behalf of other people, and especially as it relates to consumer protection. Multi-signature really is the bridge between those two that actually allows you to provide the security of a custodial owner of, or holder of funds without actually having to trust that custodial access with your funds. And so it really radically transforms the way we think about securing money in general. And I've seen a total lack of understanding, and it's not written, there's not a single word about any of this stuff and any of the documents that have come out from any of the guidances or whatever. So how do we bridge that gap? How do we actually educate policymakers to understand that there's actually a third way that is totally transformational?
You touched on this, Marcus, so maybe you can kick off and give a review.
There's no magic to it. We have to do it. And doing it means marching into their offices and explaining it to them, because their doors are open for a reason. And say what you will about the output of what the New York Department of Financial Services has done with their BIT license. Say what you will, but they have been very receptive to industry commentary. Before it was written, during the writing process, they got thousands of comments and reviewed all of them. I'm assured of this. This is how they have conducted themselves. And during that time, I think that not enough people said what they should have said about their own technologies. I mean, you see lawyers up here and you hear us saying, get involved, write a comment. It's not just business development. Like, obviously we want you to use us for that, but we exist in this industry. And if things don't come out the right way with a capital R, it's bad for all of us. So all I can say is to urge entrepreneurs to action and do something about it. You don't have to hire a lawyer to do it. Yeah. Write a letter, make your voice heard.
I was just going to make a point. One of the, I think, for me, when I was trying to get my head around multi-sig, someone described it to me in the analogy of the Swiss safety deposit box, right? So all the movies you've seen where, you know, guy goes in and takes his diamonds or whatever else of it, and you need the two keys. And so, you know, the client has the key and the banker has the key, and you just can't open it. But I don't know how that's viable or not. But it just gets me thinking, okay, so how does Switzerland or any other place that runs these models regulate their effective multi-sig in the real world? Maybe the similar sorts of frameworks need to be applied in terms of the responsibilities of each party and so forth. I'm sure obviously you'd tailor it for the technological reality of what we're dealing with, but the framework of thinking may already exist.
Yeah, and I mean, I'm traveling around conferences like this all the time around the world, and I always ask the same three questions. I don't bother raising your hands to this one because you guys will know the answers. The three questions are, have you heard of Bitcoin? And everyone's, yeah. Have you heard of the blockchain? And sort of, yeah. And then, can anyone in the room explain the blockchain to me? You know.
If you can't do it.
Well, it is the case that, you know, these are all the regulators, of policymakers, of the financial institutions, the guys who should know this stuff. And it is changing gradually. I mean, in the last year, I've seen more hands raised on the final question, but that's normally because there's blockchain guys in the room. So it's different. But it's gradually changing. I think it's just an education thing over time.
As a former lobbyist, I can tell you I've spent many hours of my life going up to Capitol Hill or even state legislators and just explaining things and using analogies and how this is the frame of reference and here's how it goes to the next level. And if you just spend the time, people get it pretty quickly.
Yeah. I agree.
You just have to do it.
Question over this side, and then we'll come to you, sir. I saw a hand raised over there. No? Okay. In which case, we'll take this question. There's a microphone edging its way towards you there.
Oh, thank you very much. My name is Greg Magershak. I'm involved with a company that tries to decentralize social networking the way that Bitcoin decentralizes money. But I find all of this very exciting, and I've been following Bitcoin for many years since it's just a technological novelty, I guess. And it was exciting to see how the blockchain grew and just the state of technology around it. What I wanted to ask about is not just multi-sig, but smart contracts and sort of the state of those. And is there, because speaking of trust, you know, maybe you could put your trust in the algorithm when you rent your car or something like that. So what do you see, where do you see that going in the next few years?
Well, maybe I'll start with a comment here, because smart contracts I think is really exciting with the blockchain, and that's why I keep saying I'm not so interested in the currency as the technology. And I do know the two have to go together, but I've been involved in a couple of conversations with governments now in Europe that are looking at using smart contracts on the blockchain for example, land registry deeds transfers. So, you know, getting the legal profession up to speed on a mortgage transfer contract of house ownership and using this as the technology to record that far more reliably than a paper trail form is actually in the interest not only of the lawyers and the banks, but of the government and the regulators. And I think that's where they're really starting to wake up. I don't know whether you're seeing that over here, but I'm certainly seeing it in Europe.
Yeah, I think we're starting to see, again, as education on Bitcoin 2.0 implementations has increased, we've seen results, right? The first, and I'll lean on the bit license again because it's a great example of government interaction with an industry. The first iteration of the bit license treated all Bitcoin transactions the same, for all intents and purposes. And if you were just in control of a token amount of coin, a fraction of a cent being sent around because it was a colored coin or it was some other kind of it was tracked in one way or another. That transaction was treated as if you were sending $1 million in a lot of ways. Somebody who facilitated that transaction needed a license. And that's crazy. We know that's the wrong result. And so we had companies from the industry who had a vested interest in seeing the right result happen, reach out to DFS, have in-person meetings, write letters, that said, look, you can't treat this stuff the same way just because it happens on a blockchain and there's something valuable exchanged doesn't mean it's a bona fide transaction currency. What did we see? A new version of the bit license with a specific carve-out for transactions that are not affecting for a bona fide non-financial transaction or something along those lines. And it worked. It just worked. We went in there, we told them, look, this is crazy town, you can't do this. They said, oh yeah, that is crazy. We cannot do that. And we saw a response. Now, does that work in every case? Can an industry always determine what carve-out it gets? No, of course not. There are often policy rationales that militate against that kind of outcome. But this is one where it was just a no-brainer. And when we saw the process work.
John from Circle mentioned that trying to get state licenses is proving to be very difficult because it's different in every single state. So right now, if we were looking at the use of the blockchain for smart contracts, which states are ahead and which ones are sort of against? Any?
That is not a coherent notion, unfortunately. Right. When it comes to smart contracts are so exotic compared to what state regulators are used to dealing with. So exotic that it's not even registering. I think that, and here's my bit of free legal advice for the day, don't pay a lawyer to go to the States to explain to them why you shouldn't need a license if you're a smart contract company. It's so far off their radar right now. It's just not a worthwhile.
Is the UK dealing with it? Is there any consciousness amongst the UK regulators towards something as exotic as this?
It's moving in that direction very quickly. I mean, it's interesting that Boris Johnson, the Mayor of London, was here this week, and I met with a guy from the UK trade and industry body that represents the government, who was accompanying him, and he was Mr. FinTech, so to speak, for UK government. And I met him in a discussion forum around how to use smart contracts for UK legal transfers. And that included lawyers in the room, regulators, the financial institutions, all the constituent parties, some of the media, academics, to say, what can we do here? Corporates, the energy company was there, land deed registry was there. So it's moving very quickly. And by way of example, there's a company called CoinJar that just won a innovation award yesterday at Finovate Europe, which is an innovation conference that's over here in spring and fall in New York and San Francisco, looking at all the fintech innovation startups that are out there. And CoinJar, the guy who founded it, founded it in Sydney, but he's just moved the whole company to London and said it's because Sydney doesn't get the regulation here. The Reserve Bank of Australia is just blocking the whole thing and saying it's all illegal, whereas London at least is open for a dialogue.
Yeah. One of the most helpful things from a regulatory perspective in public policymakers are the real-world examples of here's a multi-sig contract, here's the goods, here's the companies, here's how it played out, here's the cost savings or benefit. And I struggle with that sometimes as well in terms of we have these concepts, but can you give me a real-world example where we actually use this, or is it just theoretical? And I think that it's harder to wrap your head around something that's theoretical versus actually talking to another party who actually used it for that purpose.
I guess we're thinking about cocktails. We've got time for at least one or two more questions if there are any more points to be made. There's a question at the front here. I'd like one from the back next, so think about it.
Thank you very much. Patricia Rosenfield from the Rockefeller Archive Center. Michael Casey's comment about the developing world is prompting this one, because we haven't really, and you've mentioned it too with the Gates Foundation, we haven't talked very much about the developing world where most people working in the development area push for transparency, accountability, and governance. And so I'm wondering how this conversation and these important developments for societies that might be further along or where there is a likelihood of greater sophisticated users might have more prevalence and more positive developments. I'm just wondering, how are you going to manage the contradiction perhaps with the concerns about transparency, governance, and accountability, and not just sophisticated users if one promotes the cryptocurrency in the developing world?
I've certainly written a bit about it and looked into it, so I'll take a crack at it. I actually think, and I don't know that a lot of the sort of the hardcore libertarian Bitcoiners would see it this way, but I think there's a huge opportunity for government to adopt the blockchain technology to sort of bring it to the advantage of their own, marginalized people. It's extremely difficult to reach out to somebody who may not be tech savvy, perhaps illiterate, and is already, very concerned about the security of their marginal resources as it is, and say, here's this thing, it's this digital blockchain currency. It's really, really, that's a huge challenge. I mean, I think the poor, more than anybody else, have just greater security concerns over what we would consider to sort of be small amounts of money are huge amounts of money to them. So trust is critical, we know that for a fact, and Bitcoin has a challenge in just proving itself trustable and as trustworthy as it may well be. So I actually think that there's a huge opportunity for whatever small number of enlightened governments there are in the developing world to actually take the lead. An example I like to think of, and it's just a hypothetical, is Mexico, which has come out and made some interesting statements about their interest in an early way about the possibilities of blockchain technology to assist in governance itself, right? So again, transparency is the key issue here. And why would Mexico be interesting? Because Mexico is a case of what some people have at certain times described as a failed state. And it's an incredibly unfair way to describe Mexico because the central government it just functions very, very well. It is a good global citizen. It is actively engaged in a whole range of free trade agreements. It abides by all the norms of international behavior, and it has a huge battle on its hands with the failed states, which are literally the provinces. And out there in the provinces, you have a real problem of the traceability of money. So the money is going into the hands of the drug dealers because the police are in cahoots with them. I spent a day in Juarez, which at the time was the most dangerous city in the world, and the bodyguard that I had to get to drive me around the place told me that he had to change the radio. They were using radio frequencies to talk to each other, the fellow people in his company, and they had to change that because the police were listening in. So you're in trouble if you've got to change the technology because the police are the ones, because the police were tipping off where they were driving their clients and they were getting kidnapped, and so they changed the technology. So the key, how does this get back to blockchain technology? Because if you could find a way to use that technology to make the procurement process and the government expenditure process more transparent in the provinces and force what these municipalities are doing with their money to be in a much more transparent environment, you have a very powerful tool for the central government of Mexico to use. And then with that, you build out all this other opportunities for the poor and everybody else. So I actually think that there's a key role for enlightened governments, and there are in various developing countries. And if one or two of these start to adopt it, it becomes a standard, others move in. I mean, I think there really should be a lot of focus on finding which of those governments actually might be the ones to
I also think for the developing countries, one of the key things is that they're not taking these technologies and trying to evolve legacies to incorporate them. They're just saying, this is a whole new way of doing stuff that we could never do before because we don't have anything before. So M-Pesa in Kenya, for example, on one of their pages, tells the story of a goat farmer who is now a merchant. He's selling goat's wool and goat's milk and goat's meat on his Instagram and Facebook pages using text messaging to get the money transfers into his account. So he's now moved from being a localized global farmer to being a supplier across the whole of Kenya, potentially across the whole of Africa. And when you look at the African continent and what's happening in India, where there's more mobile phones in use than toothbrushes, what you're seeing is really transformational capabilities because people who had exclusion from the network in the past are now getting inclusion in the network. And actually, the blockchain and Bitcoin cryptocurrency capabilities in that network are going to create whole new dynamics that maybe in 20 years we'll be taking what they're doing over here.
I think you just mentioned mobile, and I think that's one of the key things when you talk about financial inclusion, because in many developing markets, I have a big chunk of my family actually lives in Africa, and I've gone to visit them, and there really is virtually no infrastructure. But the one part of the infrastructure that exists are mobile networks and mobile network operators, and they are often more trusted than the local government. They're often more trusted than local financial institutions to the extent they exist at all. And they're the only ones that really have a distribution network to get fiat fiat currency, the local currency, and then convert it into something else, a digital currency, if you which might be minutes, it might be text messaging. So I think there's going to be a very interesting potential opportunity for mobile operators to play a key role, perhaps using blockchain technology in the background to help financial inclusion going forward.
I'm getting a nod down here to say that it's time to drink. So unfortunately, my friend at the back who had a question that was considered in the back of one's head will have to keep it to oneself to share over drinks. But I'd very much like to recognise and thank Scott, Michael and Marco. Thank you for your contribution.
Thank you, everybody, for joining us. I know I learned a ton in the last 3 hours, and I hope you'll continue the conversation over cocktails and have Michael and his co-author sign the book that you're buying on the way out. Thanks again.